All right, yo, what is up for everyone that's watching this on the YouTube replay? I hope you're having a great day. Let's start this off by doing a quick portfolio update. Then we'll deep dive into some of the stocks that y'all have in the chat here. So I'm doing a little bit of a later live stream than normal. I had some free time, so I said, why not? So this is my Webull portfolio all time. I love being fully transparent. I'll share my portfolio's lifetime performance and stuff. All time, we're up 29% in my Webull portfolio, and I do have a bit of cash on hand. I'm looking to buy the dip this week. I heard like the Strait of Hormuz is getting closed down again. Oil futures are up. Yeah, I was just checking the S&P 500 futures. The S&P 500 is only down like 0.17%. So actually, the market's might not be too down bad tomorrow, or on tomorrow night. But anyway, here are all the stocks that I own in here. My largest holdings are at the top. So AMD is my largest holding. Then Futu, Dave, Microsoft, I think is such a great deal right now of a stock. It's one of the best software, AI, and cloud companies in the market. Number one, software. Number two, cloud, and a great AI play. Ooh, Reddit's a cool one as well. A quality software name, getting that high margin licensing data from Google Gemini to train their LLMs and give high quality results. Uber, I really like as well. They don't own any cars, but every time you go book an Uber, they just collect a high margin, basically royalty every time you book one of those. So, in my most recent purchase in here is actually been here. Let me search it this way. Yeah, these are all my most recent purchases in their exact order. And the stock I literally just bought, literally last week, was Netflix stock. There's my little buy right there. I want Netflix eventually. It's like 3% of my portfolio. Today, it's only 0.5% of my portfolio. In this high volatility market, now is not the time to spend all your dry powder and leave yourself with no cash. You want to slowly dollar cost average into a stock. And if this is the permanent bottom, I'm only going to buy more once it falls 5 to 10% more. And if it doesn't fall 5 to 10% more, then GG, I tried. Hey, what's up, Nick? Shout out the member Looney, Monkey D. Luffy. What's up, guys? So that was my Webull portfolio right here. Again, all time, we're up 29%. And then we have a Moomoo portfolio. In the top left, this is called my buy and never sell portfolio, because once I buy a stock in here, I literally never sell it. I'm just going to diamond hand it for the long run. And I keep it simple. I just got 6 stocks in here. To a lot of people, it kind of looks boring, no options, no crypto. But I'm a fan of, like, if you just buy high quality growth stocks, you can literally get better returns than the option people, the crypto people, the day traders, like literally just by buying and holding high quality growth stocks, dividend growth stocks as well. So yeah, year to date, this is actually what's led us to outperform the market. So year to date, we're actually up 76%. I can't believe it. The S&P 500 is up 9.6%. So it's really this portfolio that has led us to outperform. All time, we're up $35,000. And then finally, we have a Robinhood portfolio. And then right after this, we'll get into y'all stocks in the chat here. Live on a Saturday. I know normally I don't stream on Saturday, but I had a little bit of free time. So I thought, hey, why not do a quick like 1 hour stream? So if you do enjoy this, I'd appreciate it if you drop a like for me. Again, I just had to kick someone out with the same name as me. Again, I sell nothing. I'll never follow you, DM you. I have no course book. Literally just on your giving my opinion. So this is my Robinhood. Of course, none of this is financial advice, but this is my called my dividend only portfolio, where every stock in here pays a dividend. And over the past year, we are up 17.5%. Year to date, we're up only 1.7%, which does underperform the S&P, which was up like 9.8%. But these are all the stocks that we own in here. And here's my total lifetime percent change on every stock. The only company we're down on right now is McDonald's. We're down 1% on this company, but I'm not really worried about that. A lot of food stocks are really struggling right now, but out of every food stock to buy on the dip, McDonald's is one of the most defensive and best ones in my opinion. Better buy than a Starbucks or a Wendy's. And then we have a Roth IRA. A Roth IRA is just a tax-free retirement account. We started this pretty much exactly a year ago. And again, I just keep it simple. I just got 4 stocks in here. So yeah, those were all of my stock portfolios. Now I see some of y'all stocks in the chat here. What's good? Someone says, will you sell first? Are you suggesting, hey, I'm not sure what I was talking about there, but oh, where the volume at? Hopefully hello? Hopefully my mic's working. Let me know if that wasn't working. Okay. Hey, what's up, Sohal? How's it going? Sorry if I'm saying your name wrong, but what's up, Star Power? Hope you're having a great day. Nick says PANW, Palo Alto Network. Someone says, dude, invest into Robinhood Crypto. What is Robinhood Crypto? Instead of owning Robinhood Crypto, I just own Robinhood stock. I actually, this is one of my biggest regrets, was selling out of Robinhood. If you kind of look in the middle of my screen, I had 55 more shares of Robinhood, but I sold my Robinhood shares at 36 a share, and it's over $108 a share today. So I definitely regret selling the bulk of my position on Robinhood. But yeah, it's cool to see Robinhood at least is getting into crypto. So here's Palo Alto Networks right here. This is one of my favorite sectors to buy, and the sector that this company is in cybersecurity. So there's a lot of software sectors that are getting hurt by AI. They're saying AI is going to replace them, but I don't think people are going to vibe code and replace their cybersecurity systems with AI, or at least not anytime soon. So I'm a huge fan of cybersecurity, and I think hackers will utilize AI and get better at hacking, and so the demand for cybersecurity should only go up in the future. But anyway, if we judge this company based off their fundamentals, it's so good. If we just zoom out on the revenue, this is what you want to see if you're going to own a growth stock with a super high PE ratio. You want to make sure they're just hitting a new record revenue every quarter, and not just making revenue, but also net income. They had a one-time adjustment this quarter. It says they lost 177 million. They didn't actually. They just bought a company and it made a little one-time adjustment. Anyway, very impressive numbers. But the one part, oh yeah, and it's basically a subscription model company. It's all reoccurring, high margin, or highly predictable. And as we can see, that subscription revenue every year just hits a new record. So very impressive. But the bad part is Palo Alto Network at this all-time high level is extremely expensive, like more expensive than Palantir. They're trading at 190 forward PE, or in English, that means they're trading at 190 times next year's net income, which is being a little generous. Hey, what's up, DG? Good to see everyone. So Sasa said, Microsoft, please. Yeah, we'll do Microsoft. Do we still buy Apple stock? Right now's valuation on Apple isn't the best risk to reward, but Apple, especially if you just plan on holding and never selling it, it's still a good buy today. In 10, 20 years from now, it won't matter if you bought Apple here or bought Apple 5% lower. It's still going to make you a lot of money, I think. Not financial advice, of course. So I'm behind on the chat here. Next, we'll get to IAU. And what's up, Venom, Jeff Mack? Shout out to member Jeff Mack. Hey, I heard Sony stock is struggling because of the memory shortage. But anyway, let me give you a quick pitch on Microsoft. This is one of my most recent purchases. Here, literally my most recent purchases in their exact order. And I just bought Microsoft about 2 months ago. And I love Microsoft. It's the number one software company in the world, the number two cloud company in the world, and one of the best AI companies in the world. So if you think of their software businesses as Excel, spreadsheet, PowerPoint, all that, they're saying that AI is going to hurt them. If you look at any software stock like Salesforce, Adobe, they're also on this massive downtrend. So Microsoft is falling because they're a huge software company, and literally just those family of apps right there, just that software business of OneDrive, Excel, that does over 120 billion of annual revenue. But out of every software company, Microsoft is the best hedged because they literally own 27% of OpenAI. So if ChatGPT really takes over software, they're hedged as a huge owner of it. And also Microsoft, if AI really takes over, their cloud business will continue to grow. Their Azure cloud, that business also does over 110 billion of annual revenue. So point being, if you want exposure to software, cloud, and AI, which are some of my favorite sectors, check out Microsoft stock. And here's their net income. This is what you want to see. Literally, like, their net income hits a new record every quarter. They're making over 30 billion of after-tax net income a quarter, and analysts project them to stay over that. Next quarter, they expect 31, 34 billion the quarter after, and it's like a great dividend growth stock. You basically get 1% of your money back a year with Microsoft. So pretty cool. All right. Stream quality. Hey, okay, thanks. Yeah, I thought my mic was muted or something. I saw a chat, but okay. So someone said the Neos High Income Gold ETF. So I'm assuming this is selling covered calls on gold. Looks like this brokerage is telling me that there is a bearish continuation wedge. I guess the rise probability is in 95%. I don't really like to look at technicals. I like to look at fundamentals. Yeah. So basically, this looks like it owns gold and then sells calls on that gold. And, you get a 14.7% dividend yield. Wow. And yeah, basically, it just follows what IAU does, which is literal gold. Gold is ticker symbol IAU. And then that one sells calls on gold for income. All right, next up. Oh, yeah. Where the like button? YouTube slacking. Yo, Nathan, my fellow Powell owner. No way, Venom. You own Powell Industries? Dude, congratulations. I love this sector right here. Instead of just owning NVIDIA right now, in my opinion, own and check out the whole entire AI ecosystem. Own the companies doing the complex mechanical work and electrical work like Powell Industries does, the complex switchgear solutions, or own the companies doing the HVAC work, the heating, ventilation, air conditioning. Get the company supplying the copper cables to NVIDIA and Google. Amphenol's been amazing. You can own the companies powering data centers via nuclear reactors. And out of every nuclear stock, in my opinion, the best one by far is CEG. They own over 30% of all the US's active nuclear reactor. It is the purest play for nuclear energy. So those are all, and also own the companies constructing the data centers, like a United Rentals and a Caterpillar. So pretty cool. So next up, I saw Sony stock. Yeah, Jeff Mack, what's up? So Sony is right now struggling for two reasons. One is the memory shortage. So Sony owns PlayStation, obviously the Sony PlayStation. They also own Crunchyroll. I wonder if there's any. This is a Japanese company, by the way. Okay. Anyway, I actually really like Sony stock. You get a nice dividend, a 0.8% dividend yield. I think they had a slight one-time adjustment. So yeah, basically you want to value this one off next year's net income. They only trade at 15 times forward PE. So Sony only trades at 15 times next year's net income. Hey, what's up, Egg Mayo? So here are their actual PlayStation game sales. So every time you buy something in the PlayStation store, they keep a 30% fee on that. As you know, everything's 30% more expensive. But yeah, here's how Sony's revenue is diversified. Game and networking, that's obviously PlayStation. Then they're in technology. They're also in music, pictures, like Sony Pictures. They work on movies. But yeah, they own like record labels. And I think, it's so many famous people that I can't remember any of them now, but you wouldn't believe how many like rappers and singers that are signed to Sony and they collect royalties off their streams. But anyway, their margins are under attack, I think, right now from the memory shortage. Like if you look at Micron and also Nintendo PlayStation sales are struggling, and that sending Nintendo stock down, and also iPhones. Apple's now saying they're going to raise prices on their iPhones because of this memory shortage. I wonder if we can find that in the news, actually. AAPL. Maybe we'll see if we can find it. Apple CEO says look, literally, I just said this, and of course, it's like the first. I haven't looked at Apple in so long, but Apple CEO Tim Cook says product price increases unavoidable due to memory cost surge. So you know what that could mean? Higher margins in the future for Apple. Who knows if they're actually able to raise prices? Apple controls over 2/3 of the premium smartphone market share of $600 plus. Anyway, Apple's and the memory shortage is interesting. Yeah, hey, if you're on TikTok, I'm about to have to end the TikTok stream. I'm only going to be streaming on YouTube because I just got my stream taken down. So if you want to continue watching and want your stock analyzed, please go to the YouTube stream. Just type into YouTube Nathan Robert and you'll find it. So yeah, SMR. Yeah, I actually would not own Beckett with subset SMR stock. This is the small modular reactor company. Basically, this is a startup right here trying to make mini nuclear reactors. But if you didn't know, there's only 2 working small modular reactors in the world. Neither of them are in the US, and none of their own nuclear reactors are going to come online until 2030. And it's just hard to trust this company, in my opinion. Like if you really are a believer in nuclear in the future, in my opinion, this company's worth $4.3 billion, which is a huge market cap. They legit did 500,000 of revenue, 1 million last quarter. And, they lost 60 mil on that, 70 mil, 500 mil, 40 mil, 40 mil. So from a fundamental point of view, it's just a tough one to trust. You're paying for so much, like you're paying for perfection of their story. But yeah, out of all the nuclear stocks, that one I would not own. I'd rather go with the CEG, which is also still on a dip from its peak. Do you have any insight on stocks like SK and MSI, the gaming company? Wait, MSI is... I can't find that one. I actually don't believe I can look at SK, but I know they move very similar to like Micron. So the Real says, hi Nathan, speculative stock for you, XNDU. All right, let's check it out. I normally don't like to cover the super tiny caps. Actually, this one isn't even that tiny. They're worth $4 billion. Okay, so yeah, check that out. They're worth $3.99 billion, but they've had a very wonky chart. Like they gapped up and then gapped down to $13. Let's see what they do and where are they headquartered. So they are headquartered in Canada. So this is a Canadian listed company, and United States is 76% of the revenue. And okay, it looks like you're basically buying this company as they're getting their first ever sort of revenue ever. Like they did 2 million of revenue this quarter. They lost 15 mil on that, 16 mil. Luckily, they have a good balance sheet, but it's still a tough one. There's a lot of stocks out there that make this stock makes a ton of other companies look cheap. I wouldn't trust any meaningful amount of money in this one, but yeah, 2 mil of revenue, lost 15 mil, and a 4 billion market cap. I just can't get there. It looks like they're in the quantum computing industry, so maybe they're called Xandu Quantum Technologies. Interesting there. All right. So, what do you think about the war? Why did you not sell and buy stocks after it fell? Yo, I don't sell stocks. I always just buy and hold stocks, for the most part. This portfolio specifically, is if you look in the top left, it's called my buy and never sell portfolio. Because once I buy a stock in here, I'm literally never allowed to sell it. All right. Should we do ServiceNow? Okay, I'll do a quick one about ServiceNow. The unfortunate part is, and here's my quick thesis on this one. If we get another real software sell-off, this one is still going to fall a good 20-30%, and here's why. Or like a 20%. Even after its huge sell-off, it still right now trades at a 43 forward PE, which is still quite expensive. If we get another big software sell-off, this could fall to like a 35, a 36 forward PE, which is still more expensive than the S&P 500. But anyway, this one's a quality software company. If we look at the revenue, it's like literally by the quarter, the revenue hits a new record. So there's a reason this company trades at an expensive valuation. It's because their quality. Revenue hits a new record every quarter. They're making like 400 to 500 mil in net income a quarter. But even on this dip, it's still kind of a tough buy at this, 43 forward PE. But is there any news? No news around this one. But Morningstar says they're undervalued. Rapid AI monetization, continuous product expansion beyond core IT functions, and strong margin expansion potential will drive long-term value growth. So there's your thesis on ServiceNow. Interesting one. Okay. Someone said, Apple user said Broadcom. Yeah, let's do Broadcom then. What's up, Paul? We'll look at TE. I'm playing a 1 dayer, bought CDU Thurs, think it go up. Oh, hey, what's up, Larry? Wait, CIDA Space, is that ticker symbol SIDU? Let me know if you want me to analyze that one. But nice. Hey, good luck on the option. So here's Broadcom right here. This is a company helping companies like Amazon and Google make their own custom TPUs. Check this out. JP Morgan raises Broadcom price target, confirming Google TPU program on track till 2031. Just ridiculous. Broadcom pursues strategic initiative to boost semiconductor chip demand. There's a lot of news around this one. Anyway, let me just show you how impressive Broadcom is. And basically, the way you want to value this one is looking off next year's net income, because there's so much net income growth that's about to happen. Check out 2 quarters on the right. The orange line's what analysts predict, and they always beat on earnings, but they project $15 billion of net income in 2 quarters, $15.4 billion of real after-tax net income. It has never even been close to $15 billion of net income before. There is still massive net income and EPS growth for Broadcom. So that's why you don't value this one off trailing 12 months PE, because it says Broadcom trades at a 68 times net income. You value this one off next year's net income, and it literally gets cut in half to a 31, because the net income / EPS is growing more than 100% this past year. So, and imagine if you do a 2-year out forward PE, it's at like a 28 or something. So for the growth that they're experiencing, like if we just go to their main semiconductor solution business, which is 67% of their whole business, it grew 78% year over year. That is the fastest growth rate on the entire screen. Like the growth rate is growing. Part of this is from Google ordering more TPUs through Broadcom, and they have a 0.6% dividend yield. So that one's cool. And they're actually they're reasonably valued, maybe just slightly pricey, but they deserve it. So Paul says TE stock. This is not TE Connectivity, T1 Energy. Okay. So this stock is the same IPO price as it was in 2020, but they've had a great year. Like 1 year ago, this was a $1 stock, and it's $9 today. So congrats if you bought this one a year ago. You definitely are up on your money. Looks like they do manufacturing and sale of, so solar company. Okay. So this is a company headquartered in Austin, Texas that manufactures solar panels. I remember looking at this one earlier. So yeah, they're a literal US producer. The bad part is China is like printing out solar panels hand over fist, where they just get so good at it. They've gotten the price so cheap. So yeah, the tough part is if we go to their margins, they're still not profitable yet. So actually, they've never made any money ever. So like if we just zoom out, they lost 20 mil, 190, 130, 30, 16. So they just lose a lot of money, but they have the revenue growth to like justify it. Like the Q1 of last year, they did 50 mil of revenue. Now they did 177 mil of revenue, up 232%. So at this growth rate, what's the revenue going to be at the same time next year? Actually, let's see what the analysts project. 196, 250, but I guess they're actually not supposed to lose that much the next 2 quarters. They're only going to lose 27 and 24 million. So it's actually good to see that they're going to narrow their losses, but still a tough one because there is no forward PE yet. But if you're looking for American solar technology, manufacturing. That could be a cool one. My favorite, I've looked at every solar stock, like Enphase Energy as well. Out of every solar stock that exists, my favorite one is actually FSLR, First Solar. Again, if I'm going to own a stock, I want to own one that makes net income, makes free cash flow, and check out the net income on First Solar. Again, we just saw that other company, they haven't made any net income. This one actually makes a couple hundred mil in net income a quarter. And when a company makes a couple hundred mil in net income a quarter and has no net debt, a fortress deleveraging balance sheet, they can return money to you via share buybacks, dividends, and do M&A, which is mergers and acquisitions that help out their EPS, accretive to EPS acquisitions, all without having to dilute you as a shareholder. So First Solar, you think this one might be expensive, but they only trade at a 13.3 forward PE. Again, solar panels kind of a commodity, but that one's my favorite. Hopefully that was kind of helpful. Sorry if I'm spending a little longer. So what's up? Tomboy said CDNL. Yo, we were wanting to own this stock so bad. They do rock blasting and like terrain control, custom terrain work for data centers. They literally just had one like mega data center order where they're doing all the foundation, like leveling work for this data center about to be built. That made them like $40 million for just one contract. But actually, here's the cool thing. Actually, unfortunately, this stock is at an all-time high. And the weird part is, you see, if we look in the top right, the market cap is 1.24 billion, but the owners, that's the amount we're able to buy. Only 33% of this actual company is available to buy. The insiders still own 66% of all the revenue, and they have like this revenue share agreement thing. But anyway, if we just judge this one off the fundamentals, this one's in such a unique industry. I think this one could be interesting to put on your watch list if you like AI infrastructure. Okay, where's your investor presentation? Here we go. So yeah, it's a pretty niche industry, clearing, erosion control, earthwork, rock removal, blasting, and 80%, look, strong relationships, 80% plus repeat customers. But where is look at backlog. They have a literal $850 million backlog, and the whole company, even with the insiders, is worth $3.5 billion. But yeah, they, where's their EBITDA right here? They were given like EBITDA margins. Anyway, I won't. 2026 kind of is 20% plus EBITDA margin target. Anyway, pretty cool AI infrastructure company we were analyzing. It says, again, the forward PE is a 14.9. That's actually not accurate. It's actually like a 35 because of the owners. But yeah, fundamentals are intact there. I can see why they're at all-time highs. That's a cool niche one you could put on your watch list. No concerns with the Microsoft lawsuit. Hey, what's up, Mike? What is the Microsoft lawsuit? Actually, I haven't heard about that. Wonder if we can find that in the bearish news. EU expected to designate Microsoft Azure and Amazon Web Services as gatekeepers under Digital Marketing Act. What is this here? Microsoft is seeking cloud capacity from alternative providers to prioritize Azure resources for customers. Oh yeah, like what that means is Microsoft is renting out GPUs from like Nebius, like NBIS. Anyway, but yeah, let me know more about that, Mike, about the Microsoft lawsuit. I haven't heard about that we were actually just analyzing Microsoft. This is one of my most recent purchases. I just bought some more shares of them, and I'm actually not worried, especially because Microsoft's only at a 21 forward PE. The risk reward is so good. I don't see Microsoft trading at like an 18 or a 19 forward PE. Like that would be insanely cheap, and I'll be buying more. I'll be doubling my position if that happens. But yeah, the reason Microsoft is falling right now is because they're the world's number one software company. Think Excel, spreadsheet, PowerPoint. They're saying that's going to get hurt by AI. But any software company is on a similar downtrend, like Adobe, Salesforce, ServiceNow. Microsoft, though, is the most quality because of their Azure cloud business and their ChatGPT investment. They own 28% of OpenAI, which owns ChatGPT. So if OpenAI and AI really takes over their software business, they're hedged more than any other software stock, I think. All right, so what about gold? Can you check it out, please? Yeah, Emmanuel. So gold, this is ticker symbol IAU. It's the literal commodity of gold in an ETF. This one's run by BlackRock. So if you literally look up the price of actual gold, it is identical to this right here. So it's literally the commodity of gold in an ETF. And arguably, it's actually smarter and safer to buy gold in an ETF because you also, versus buying physical gold. Especially if you buy gold in like smaller quantities, you're paying very high spot fee prices whenever you buy it and sell it. And the expense ratio fee here is cheaper. And if you own a lot of gold, you got to pay for storage and maybe even insurance and stuff. It ended up being smarter to buy the ETF. And it's super liquid. You got to back, get your gold, go to a pawn shop and sell it or whatever. But this ETF, you can buy and sell instantly whenever you want. So yeah, actually, here's a life hack. There's IAU, and then there's IAUM, also run by BlackRock. Here's the price of gold in the blue next to it. This gold ETF only has an expense ratio fee of a 0.09. So that's the fee you pay every year, 0.09% of your holdings. Anyway, you probably want some commentary on if I think gold might be undervalued. Gold probably is a decent nibble right here. It's seen as like a more safe haven asset. I know the Strait of Hormuz just got shut down again, so maybe if war fears start to escalate, oil prices go up, maybe that'll benefit gold. But the thing is, did you know all the gold in the world is worth over, I think, $40 trillion. So you're kind of like buying gold at a $40 trillion market cap. For it to double again, gold would be worth legit $80 trillion. It's already the world's #1 asset by value. They say gold's like literally like stardust. All right. Tom says, oh, yo, we just did a deep dive. I saw your question on Discord too. He says, Broadcom or NVIDIA for better growth? Honestly, it's such a tough question. I honestly don't know because both are so good. If I just had to pick one right now, I'd probably pick Broadcom, but I still love NVIDIA and I'm not bearish on NVIDIA. I'm actually bullish on NVIDIA as well. Here's why it's hard to be bearish. I know a lot of people, when they see this chart, see a very overbought stock at an all-time high. Like, who's going to buy this? But here's the thing. When we judge this company fundamentally, did you know NVIDIA only trades at a 20 forward PE? So they only trade at 20 times next year's EPS or next year's net income. And this is like the picks and shovels play of AI, obviously selling the GPUs and the chips. NVIDIA pitches Vera CPUs to Chinese customers amid H200 GPU tensions. NVIDIA invests $2 billion into Coherent's indium phosphide wafer facility. NVIDIA B200 GPU rental prices set to nearly double as delivery times extended to 15 months. That's probably good for like Nebius or something. We could read all the news here. I love just going through the news. NVIDIA secures copper foil capacity directly from suppliers 1 year in advance. That might be why Amphenol is going up so much. Amazon in talks to sell Trainium AI chips to third-party data centers, challenging NVIDIA. This is why I actually love Amazon. They're literally selling their own TPUs. The CEO of AWS just said if they were to fully sell all their TPUs, they would make, just that business would be an additional $50 billion of annual revenue for them. And, Amazon's smart. They're like, hey, NVIDIA literally has a 70% net margin. Amazon's like, hey, for the price, you can literally get just as effective chips, compute for your money, but we'll sell it at a 30% margin. So they still keep a huge margin. They just don't, basically, they have their own cloud, and when you sell your own TPUs with the cloud, it works really well. That's why Microsoft also might be a little bit struggling, because Microsoft isn't selling their own TPUs. Google's selling billions of dollars of TPUs to Meta and other companies. Amazon could sell $50 billion a year of TPUs. Microsoft does not have their own chip though. All right, next up. Sorry if I'm a little behind here. Actually, hey, if you're on TikTok, I'm ending the TikTok stream right now. If you want me to analyze your stock, just type into YouTube Nathan Robert and you'll find it. I don't know if y'all can see this, but yeah, TikTok stream got cooked. So anyway, if you're on TikTok, go to YouTube, just type in YouTube Nathan Robert, you'll find it. Thanks again. See ya. Sorry, TikTok's giving me issues. All right, so let's see what's next here. TIGR and SMCI both had different funds by millions of shares. Yo, Super Microcomputer, this is the company where, let's say you own a data center. You go buy a bunch of NVIDIA chips. Well, you hire Super Micro to come install it on the servers and do all the cooling work for you. So they help install the chips for you. It's kind of a commoditized, low margin industry. The margins have gotten lower because of Dell. Dell and Supermicro are like the two best in the game. But here's why it's also tough to be bearish on Super Microcomputer. Also, they just diluted all shareholders by 30%. So if you're wondering why did they just gap down right here on no earnings day, they just diluted all shareholders. So you own 30% less of the company, but they say they're doing this because it's going to make their, $7 billion equity, $7 billion of shares. The whole company is worth $19 billion. So that's a huge chunk of the whole market cap. Anyway, the forward PE is an 11.3. So they really do only trade at 11 times next year's net income. That is pretty cheap, I will say. But also they're cheap right now because they've had a lot of fraud. Like, they literally smuggled chips into China to prop up previous net margins, and that's why they tanked on this day. But they've just been up ever since. Oh yeah, and this is when I used to own Super Microcomputer. Super Microcomputer literally this day I was streaming, I think, was supposed to report earnings. They just didn't report earnings that day. They just never did the filing, and investors were freaking out. It was super delayed. But anyway, hopefully that was a little helpful there. Sagittarius says Lyft stock. Hey, I actually prefer Uber. I did just buy Uber. It's one of my most recent purchases. I like Uber more because Uber has this Uber Eats business and this B2B business to business delivery and freight business. When you think of Lyft, Lyft is a pure rideshare play. You know, Uber can like deliver your groceries and stuff to you, but this one is just a rideshare. But this app is telling me, what is this right here? There is a bullish continuation diamond, and that means a 90% rise probability according to technicals. That is a weird looking chart. I've never seen a chart look like that before. Anyway, if we look at this one on a forward multiple, it's honestly pretty inexpensive. They traded 18 times next year's net income. We're looking at next year's PE because this is artificially high or low. They're not trading at 2 times net income. They had a one-time adjustment to their EPS, artificially making it look that cheap. Like the last quarter, they did not make 2.76 billion. They made or actually, it says they lost 185 million. But anyway, we value this one off next year's EPS. They really only traded 18 times next year's net income. And Uber, I think that's the literal same valuation as Uber. Uber trades, at a 17. So, let's see. Is there any updates on this one? So Morningstar says they're reasonably valued, while execution on cost discipline and third-party partnerships support near-term profitability growth. The company's lack of self-reinforcing network effects and smaller scale relative to Uber constrains long-term value creation. Yikes. But I still wouldn't be worried about this one if I was a shareholder. Ride-sharing revenue increased, driven by a 90% rise in gross bookings. Profitability improved with net income up. Cash flow generation was robust. Cool. All right, let's look at the next one here. What's up, Jeff Mack? Let's do SFD. I think this is Smithfield Foods. So this is a recent food IPO. And if you look at any food stock right now, like a General Mills, a Campbell's Soup, even the restaurants like a Wendy's, Jack in the Box. Look at these. They are struggling very hard. So General Mills, you can buy this one on a dip. It has a 7% dividend yield. This is another interesting one, but it hasn't experienced the same dip that the whole industry is facing. So Smithfield's, you buy this one today, you also get a good yield, 4.3% of your money back. But let's go see what they actually own. Yeah, another food packaged goods company. Let's check out their maybe family of brands. Can we find that? Welcome to Future. Smithfield. Okay, yeah. What do you own? Oh, maybe these. Okay, our brands. I haven't heard of. Oh, Nathan's Famous Hot Dogs. They had like the contest. Farmer John, Farmland. I think it's like an egg or bacon brand. Cooks, Curly's. I think a lot of these. I was reading their investor presentation earlier. I think this is like a high quality, premium deli. Most of their sales are international. Let's see if we can find that out. Actually, they should break it down geographically. Okay, so here basically they don't do it geographically here, but packaged meats is 56% of revenue. Fresh pork is the other like 40%. Hog production. So right now there's a huge beef shortage and like pig shortage, and there's just basically a lot of inflation in the pork and meat market right now. It's crushing in restaurant margins. That's why McDonald's is slowly going away from beef and switching to promoting chicken right now because beef is too expensive. But yeah, that's probably why I suspect this one's doing better because of the inflation around beef. I think Tyson Foods is also kind of benefit. Well, they just had a big gap down. Anyway. All right, next up here, is it still advisable to buy NVIDIA right now? I actually would say so. I wouldn't go crazy, but honestly, if you just want to park cash somewhere, NVIDIA is not too bad. We just analyzed this one like 10 minutes ago, so I won't analyze it again, but this is why it's tough to be bearish. They're trading at 21 times next year's net income. I'm a believer if you just buy a share of NVIDIA today, like even today, if you buy NVIDIA today, you should get S&P 500 type returns, around 8 to 10% of your money back a year. That being said, this isn't a double or a triple play anymore, because right now, the company is worth $5.1 trillion. For you to double your money, they have to be worth $10.2 trillion. So just from like a law of large numbers point of view, it's a tough double. But I still think at this 20 forward PE, you should still get like 8% a year. I didn't know about Amphenol until you put me on it. Buy heavy in 120s. Hopefully good things. Yo, I'm very glad. Yo, I have been shilling this one like crazy. Every time it falls to this $120, $130 level, I promote Amphenol like crazy. Basically, This is the company that provides NVIDIA and Google with the copper cables and fiber optics. Like the NVIDIA NVLink spine uses like 7 miles of copper cables in this little box, and a lot of that's provided by Amphenol. Google's TPUs, a lot of the supply chain supplied through Amphenol. And even though this stock is pretty close to an all-time high, a competitor would be like a Corning, a GLW, or a Credo Technologies. This one, even close to this all-time high level, is only hit a 30 forward PE. So they're only trading at 30 times next year's net income. Here's why that's fair. Their main business grew 87% year over year. Their communication copper cables, harsh environment solutions is up 33. Interconnect sensors is up 25. They make these heavy, like 10% of the revenue actually is like aerospace and defense military products and subsea cables. Like the internet is really run on subsea cables, and they provide a lot of that too. Anyway, basically an AI infrastructure play. If AI demand continues, especially what we've seen is a reacceleration of CapEx. What we don't want to see is Google and Meta and Amazon slow down their CapEx spend on AI. What we've seen is not that. We've seen them reaccelerate how much you're spending on CapEx. Google just rose $80 billion of their own stock. They diluted shareholders by $80 billion. Meta, I think, just rose tens of billions of dollars also via issuing shares. That's the last place stocks go to raise money, is diluting shareholders. I wonder if I can find that news. Nah. Did I just unplug my mic? Hopefully not. Okay, let's find this next stock here. All right, so actually Meta I also think is a great deal. So Gabe said, HNST, honest company. Yeah, so to be honest about the honest company, the last time I looked at them, I was disappointed. They sell a low margin commodity. They sell diapers and wipes. That's 80% of the revenue, just diapers and wipes. They're like healthy versions. But if you look in the top right, it's a micro cap. They're only worth $415 million. And here's the tough thing. They are in now negative territory of growth, where the sales, the lifeblood of the company, the revenue is actually negative 19% year over year. So they sold 20% less than the previous year. That's not good. And they're not just, revenues on a decline, but also, they're not really making net income like they used to. They used to kind of get net income positive, but now it's struggling again. So anyway, that's why it's a tough sell for me. There is no forward PE. Yeah. Anyway, that's the tough part. I mean, it is unfortunate that most of their, or that the revenue was on a decline. Yeah, look at that. So diapers and wipes, that's 63% of the revenue. Skin and personal care is another 30. But yeah, low margin commodity there. So Tom, what's up, man? Says MRVL. Yeah, let's do Marvel. Then we'll do AAOI. Should we buy more? Should we buy more stock of Netflix on Monday? How are you, by the way? Hey, what's up, Mo? I'm doing great. Actually, yeah, let's look at Netflix after this because I have not analyzed Netflix yet. But that is my most recent purchase. And I'll give you my thesis on Netflix after this. So here's Marvel Technologies right here. They are helping also Google with their custom chips. Let's see if there's any news around this one. Marvel holds the second highest market share in the ZR Plus module shipments and the iPod. I was doing research onto this. This purely benefits Amphenol, ticker symbol APH. But look at this. One of the reasons why this stock is at all-time highs right now is NVIDIA literally bought the stock. NVIDIA took a couple $2 billion stake into Marvell. And the NVIDIA CEO said the Marvell is the next $1 trillion company. And Marvell actually to join the S&P 500 on June 22nd, replacing PoolCorp. So as they get into the S&P 500, there's going to be so much passive buying, order flow buying as the S&P 500 copy ETFs also buy and hold a bunch of Marvell too now. But anyway, Morningstar says they're overvalued. The company's strong position in data center optics and custom AI compute chips drives robust growth, but its high concentration in data center spending and intense competition requires caution. So yeah, you do want to be cautious, especially at an all-time high. It would be a better risk to reward a little bit lower than here, because if we do a forward PE on this company, we even be generous and value this one off next year's net income. They still trade at 127 times next year's net income, which is more expensive than Palantir. But they deserve to be doing so well. Like a year ago, no one was buying the stock. They were losing a couple hundred mil a quarter. But now Marvell has brought the growth back. They're now making a couple hundred million a quarter of net income and profits. And the EPS growth. Basically, actually, we should just look at the EBIT growth because they had a slight one-time adjustment. If we just look at earnings before interest taxes, as we can see, the orange line's what the analysts expect. On the left, it's going to go from 750 million all the way on the right to $1.14 billion. So yeah, lots of EPS and net income growth to come. But the risk reward of buying today is definitely very tough. Yeah, NVIDIA just bought that one and they get the S&P 500 inclusion. Very interesting. So AAOI, this is the raw substrate play. Basically, they don't... Oh, wait, never mind. Actually, I'm thinking of a different company. Forget what I just said. This is actually a data center company. I think it's the data center leasing company. Applied subsidiary secures 500 million credit. Okay, looks like insiders are selling or something. Anyway, we judge this one. Oh, wow, look at the EPS and net income growth. So if we look at current net income, they have never made net income. Yeah, if we zoom out, they've literally never made net income ever. But finally, it sounds like in 2 quarters, they're going to start being consistently net income positive. They're only going to lose $2 million next quarter, and then they're going to make $24 million net income, and that's real as well. Like, look at the revenue. Revenue on the left is going from 119 to 264, and that should make them get net income positive. So you're basically buying this company as they're getting net income positive for the first time ever. So they're probably going to look very expensive. Yeah, an 85 forward PE. That's because they're just now getting net income positive for the first time ever. Looks like they also have this cable television business, which that's not an industry I'm a big fan of, but it looks like that might be at a record revenue. Anyway, it's an interesting business. It's like a data center company and also a cable television company. It's like, oh, here are their actual components. Here's their website right here. Yo, what's up, Daniel? No, this ain't pre-recorded, but yeah, what's up? I'm streaming on YouTube and TikTok. Yeah, hey, if I take down my TikTok stream, wait 10 minutes and restart it again, the restriction goes away. But I think I might just get restricted again on TikTok, so I don't know. Pick one, Microsoft, Netflix, or Meta. I'd pick Microsoft right now, but to like super go crazy in. But now let's get to Netflix as literally my most recent purchase. So I eventually want Netflix. Here's my position here. I eventually want Netflix as 5% of my portfolio. Netflix is only 0.5% of my portfolio today. And I told myself I'm only going to buy more Netflix once I'm down 5%, and once I'm down 10%, I'm only going to buy more once it falls more. And that's how you really should look at stocks right now in the super high volatility market. You don't want to spend all your cash and have no leftover drying powder. So here's why I think starting a nibble on Netflix kind of looks decent. Again, not the time to go all in. It's a time to maybe start a small nibble, small dollar cost average. But they traded a 23 forward PE or 23 times next year's net income. I don't see it getting much cheaper than that. Netflix is very quality. It's a subscription model company. Netflix just rose prices by $1 or $2 a month. And I don't know about you guys, but we're not canceling our Netflix subscription. Netflix has something called pricing power. And check out the net income over time. We're looking at the before. They had a one-time adjustment this quarter, but excluding that one-time adjustment, check out the net income over time. They really are the most profitable ever, especially after they did the password crackdown in 2022. And they introduced now an ad tier business. I'm actually extremely bullish on Netflix's advertising business. So any news? Netflix loses acquisition bid of Roku. I don't know if that's... Netflix reportedly interested in Lionsgate Studio acquisition. Later denies interest. Anyway, Netflix was trying to buy Warner Bros. Discovery. They chose not to, and I actually like that they stuck away from that. And they actually just announced a 30 billion share buyback program, or over 10% of all the shares. So basically, my favorite part about Netflix is the way they return money to you as a shareholder. So Netflix doesn't pay dividends, but they basically return money to you by buying back their own stock, giving you more ownership in the company. And here's how you can tell how much percent of the company they've bought. So the net income grew by 82%, but the net income per share grew faster. It grew 86%. How did the net income per share grow faster than the net income? Well, it's the per share part of the ratio. They bought back 4% of all the shares, so the EPS grows 4% faster. That's literally, if they chose that money to pay it out in a dividend instead, you literally get 4% of your money back instantly in a dividend of cash. But I like that they do it in share buybacks. So yeah, hey, what's up, my music? Yeah, I do really like Netflix. Supermicro is horribly run company. Yeah, the management's a tough sell there. If you really love Supermicro's industry of like helping out installation, you would love Dell. Dell does the exact same thing as Supermicro, and this one's like a value stock that's at like an all-time high. Even at this near all-time high level, Dell doesn't look crazy expensive at only a 24 forward PE. That's like the valuation of like the S&P 500. So what's up, Ray? He says BFLY. Let's check out BFLY. Hey, what's up, Nick? I'm going to get a nice paycheck. What should I get in your opinion? Just very high quality companies like a Microsoft. Maybe not so much. Not don't go crazy yet, but maybe Netflix. I like Uber, and maybe find software companies or the quality software companies. I'm looking at AppLovin, Reddit stock. But anyway, it all depends on what you want in your portfolio. So here's Butterfly Network. I've actually not heard of this stock before, and they just ran up 55% on just Friday. So congrats if you own this one before today. Is there any like specific news here? Maybe you can tell me what the news here is. I don't even know what this company. Let's check out the revenue though. So they do hardware and software. What hardware do they sell? Like, are they in memory? The revenue is growing nicely. Actually, revenue's at a record right now. If we zoom out, the past 2 quarters are record revenue. What about net income? And they're losing like 10, 12 mil a quarter. So they're in the medical devices industry. Huh. Here's their website. Bring in power of ultrasound into your assessment, diagnosis, and treatment. 145,000 plus customers chose Butterfly to elevate patient care. Clinicals save up to $900 in our all-in-one probes. So I don't know if this helps out like pregnancy or stuff like that. That's what it looks like right here. I don't know. Ultrasound solutions. Maybe they sell like the medical devices that do that. University of Rochester Medical Center boost ultrasound charge captured by 116% system-wide deployment using Butterfly. Anyway, some sort of medical device company. It's actually kind of interesting there. I'll put them on the watch list. If they were up 55% on Friday, they had to have gotten some good order or something, So, next up, what's up, Power? Someone said, I just got a 100K check. What would you do? Well, what would I do? I would just invest it in high quality stocks. I wouldn't risk it in anything risky. The goal isn't to get rich quick. It's to slowly build and preserve that 100K. Put it in high quality companies love and trust, like a Microsoft, S&P 500. The S&P 500 would be the safest answer. If you don't want to lose that to inflation, historically, the best way to beat inflation has literally been assets like stocks, the stock market. Historically, the stock market, the S&P 500, does 8 to 10% of your money back a year. All right. Oh, watch out for these people in chat here. Okay. Yeah, I'll never follow you, DM you. I sell nothing. I have no course book. I'm just on here giving my opinion. So Bud said Hub stock. Hey, remind me to get to FN stock. I'm a little behind here. I apologize. What's up, Sagittarius? I'm late to the party. Are you in SpaceX? Hey, what's up? I'm actually not in SpaceX stock. I do think that one is overvalued long term, but short term, it might still go up because of the low float. Yeah, long term, I am kind of bearish on current SpaceX valuation. Somehow, SpaceX is literally worth more than Microsoft right now, which I don't believe. It's not going to stay like that long term, I don't think. All right, so let's look at HubSpot right here. This one's like a smaller Salesforce right here. So they basically do the exact same thing as Salesforce, but Salesforce, ServiceNow, Hubs, they are all on this massive software sell-off. They're saying AI is going to hurt them. What is Morningstar saying? Actually, Morningstar doesn't cover this company, or do they? Oh, here's what they say. Here's what the bulls. Please stop. Okay, here's what the bulls are saying. HubSpot has made a splash in the small, medium-sized business market with its freemium model, easier implementation, and simple and feature-rich software. HubSpot does not have to beat out Salesforce or Microsoft, but by offering credible solutions and an expanding portfolio to the mid-market, we think it can grow rapidly in an underserved niche. Huh. Here's, I guess, what the bears are saying. HubSpot is likely to face increased competition from Salesforce and Adobe alongside with AI as it continues to refine the portfolio. So yeah, it looks like the bear case is focused around this AI thesis. Anyway, though, what impresses me is that they're saying AI is going to hurt this one in the future. Look at like revenue. Literally by the quarter, revenue hits an insane new record. And not just revenue, but for the first time ever, HubSpot just made an actual profit for actually the past 3 quarters in a row. Because for all of history, they used to lose a lot of money every quarter, but now they're finally making net income. So they basically just got net income positive for the first time ever. That's why they still look expensive at a 40 forward PE. But honestly, it could be an interesting one to maybe put a little bit amount of money in. If we get another huge software sell-off, maybe the forward PE could fall even lower. But yeah, maybe the worst is already fully priced in. Look at gold. Yeah, hey, gold is ticker symbol IAU. Yeah, checked it out. It is on a little downtrend right now. I know over the weekend we just had news come out of the Strait of Hormuz and the ceasefires like ended or not ended. It's like it's resumed, I should say. There is no ceasefire anymore, and the Strait of Hormuz is shut down again. No captains are sailing through it, or no sane captains. So oil prices are up. So maybe gold is like a safe haven asset. Will benefit from that. But yeah, I don't know. I wish I could give you more thoughts on them. Gold's kind of interesting. Gold can't report net income and miss on their net margin, and it's kind of like a catalyst-free asset. What site is this? Hey, I'm actually on a brokerage. It's a broker where you buy and sell stocks on. If you actually want to get this app, it's my favorite app to like analyze and buy stocks on. I actually have it linked in bio, LinkedIn profile, or linked in description there if you're on YouTube. Yeah, if you're on TikTok, LinkedIn bio there. Or you can just type in Google Moomoo. It's a brokerage called Moomoo. So let's check out SpaceX stock. Yeah, so SpaceX right here, they are worth 2.43 trillion, which is more than Microsoft. And here's the tough part. Here's what Morningstar says. So CPAs and stuff, they say Morningstar is significantly overvalued. The aggressive, lofty valuation implies that all highly uncertain projects, such as rapid Starship reusability and the commercialization of orbital data centers, will execute perfectly according to the most optimistic scenarios, which warrant extreme caution. So yeah, this 2.43 bill market cap, it is like severely overvalued. But the reason it's at this price right now is because of the low float. Only 1% of the shares are available right now, and everyone wants SpaceX. So there's no selling on the order book. In 1 year from now, there's literally going to be 40x more shares available. So it's just like a low float thing right now. It happens with every IPO when they first IPO, like Webull with low floats. They always, rally up the first couple of weeks and then kind of slowly bleed out as investors really start to digest the real fundamentals of the company. AppLovin and Reddit are not for the faint of heart, very volatile. Yeah, like most software. Let me actually analyze AppLovin. I promise you'll like this one, not financial advice. If you want, or if you're looking for a software stock to buy, especially if software continues to fall, in my opinion, buy AppLovin, not financial advice. And I actually just bought AppLovin too. They're also down like 50% from their peak, like most software, like a year ago was 730. Now it's 460. But out of every software company, here's why this one is my absolute favorite. So check out the revenue. Revenue grew 58% to 1.84 billion. On this 1.84 billion of revenue, they kept, after paying taxes, 1.21 billion on that. The before tax was 1.44, so that's really after they paid 220 mil of taxes. That literally means their net margin is a 65%. They are basically collecting royalties. So for every $100 that come in, they keep $65 after tax of net income, and they keep over $70 of that in terms of free cash flow. I can't believe it. So if we just look over time, the net income is growing very fast. Like net income is literally up 109% year over year. At this growth rate, what's the net income going to be the same time next year? And here's the net income forecast. It's supposed to be 1.27 billion next quarter and 1.39 billion the quarter after. That's going to be growing from 835. So no wonder this is one of my favorite stocks. And check this out. The forward PE, you really want to value this one off next year's net income because this is a growth company about to grow their EPS another 100%. They're only trading at 26 times next year's net income. That's literally an S&P 500 multiple. I think that's fair. Morningstar says they're fairly valued. The AI-driven Axon engine successful expansion into non-gaming advertisements offers strong growth potential. The severe uncertainty surrounding data collection, regulatory scrutiny, and optimizer performance saturation warrants caution. So there was some SEC investigation into their data collecting practices. I guess their ads are just so good that they're targeting people too well. I don't know. Looks like AppLovin CEO sells 50 million of stock through multiple transactions. Yikes. Anyway, here's my AppLovin position. I have 1.5 shares. I'm always kind of a fan of buying fractional shares. Yeah, there's my little buy order there, but yeah. Software falls, especially if AppLovin gets back down to even close to my cost basis, I will definitely be adding to my position and try and get another share. Put it all in on TQQQ. Yeah, I would be careful with the TQQQ. So, yeah, dang, there we had Bitcoin. How? Let me remove that. Anyway, TQQQ. This is like a. Is that the 2 or 3x Nasdaq ETF? Anyway, a 1% expense ratio fee. This is something you short-term swing trade, day trade. You want to get in and out of that one as quick as possible. All right, so Western Digital stock. Yeah, let's do that one. It's up 50% this month, but it might still be a good buy. What do you think? So this is another memory shortage company. They do the same thing that Micron does, the same thing that SK and Samsung and SanDisk do. They're selling RAM, hard drives, memory, and there's a huge shortage because of data centers taking up all the demand. So memory sector rallies on AI infrastructure demand. Apple CEO cites unavoidable price increases due to memory chip shortages benefiting Western Digital. Huh. Wow. The Wall Street Journal said that price increases are unavoidable as AI demand strains DRAM and NAND supply. Those are the memory that like data centers use because it actually retains it way better. Cook described the situation as unsustainable as suppliers pass on higher prices. Well, anyway, Western Digital HDD prices rise 10% in Q2, marking 5th consecutive quarterly increase in their prices. Anyway, another memory shortage company, so no wonder this stock is at an all-time high, just like Micron and SanDisk are at all-time highs. But it's starting to get you want to be a little careful because of the forward PE. According to analysts, they're trading at 46 times next year's net income. Maybe that doesn't include the price increases or updated projections. What is this? Projects HDD supply shortage through 2028, driven by AI demand. So yeah, basically this one trades off the sentiment around the memory shortage supply chain. If all of a sudden we fix the supply chain and they just sell a commodity again, RAM, memory, this is a commodity. It should be a low margin commodity. Eventually it'll fix itself. But for the next couple years, we're sinking 2027, 2028. That'll be peak ever EPS. Thanks for streaming. Hey, no problem. Yeah, I wanted to do a quick little Saturday stream. I normally don't stream on Saturdays, but I thought I'd do a quick one. Hey, if you're enjoying, please leave a like. We've been streaming for an hour now. I appreciate that. So Sophie says, what do you think about Rockstar stock? Hey, are you talking about Rockstar as in Take-Two Interactive, the company that owns Rockstar Games? Or maybe you mean Celsius, who owns Rockstar Beverage? See, I just don't know. But in the case that you're talking about Take-Two, which is the company that owns Rockstar Games, which is the company that owns GTA 5, and as you know, GTA 6 is about to come out. Take-Two announces Grand Theft Auto 6 pre-orders opening June 25th. Wow, and that's in 5 days. What's the revenue? The base edition expected to price at $70 to $80. PC release, bro, no. The PC release is projected for April 2027. Dang, so we got to wait even longer for the PC version. Anyway, if you got a console, though, it's actually fun playing GTA 5, just driving around on a console, though. Anyway, this stock I would still be cautious with because if we go to net income, historically, they actually don't make money. For the past 3 years in a row, they haven't made a single dollar of net income a single quarter, and they've cumulative lost over like $7 billion of net income. Here's what Morningstar has to say. They're overvalued. While the highly anticipated release of Grand Theft Auto 6 will undoubtedly drive massive revenue spikes, the market is pricing in unrealistic long-term growth expectations that ignore the inherently choppy nature of the firm's sporadic major game releases. So that's the tough part. They're not projected to make net income in the next 2 quarters. And there is no forward PE. So when there's no forward PE, they don't make net income or free cash flow to return to shareholders. It makes it a tough sell, especially, after its rally. Hey, what's up, Mr. Phil? Can you check out the trade desk? Yeah, this one is seeing some, a lot of competition from Amazon. Actually, fun fact, well, not good news for this stock. Netflix used to use the trade desk to find their advertisers on their ad tier subscription. Now Netflix actually switched over to Amazon. The trade desk and Publicis settled dispute over ad tech fees, resume partnership. Oh, cool. Anyway, We think the worst might be fully priced in at this point because look at how much this has been beaten down. This is your pure advertising company. But check this out. At a 16.9 forward PE, it does look pretty cheap, only trading at 16 times next year's net income. But here's what Morningstar has to say. They're overvalued, intensifying competition from Amazon's demand-side platform, and a structural disadvantage in proprietary consumer data require caution. So maybe they're just not the best in the space, and maybe they won't be able to have pricing power. Yeah, look at the third line. Amazon's demand-side platform directly targets their advertising space on the open internet, and its scale allows it to outperform. So that is one thing to be cautious about. And hey, if you're like worried about Amazon, being a competition for everyone, because they are in every industry, even like coming for NVIDIA, making their own NVIDIA chips, just own Amazon. I love Amazon. Administration threatens 100% tariff on French wine over digital service tax on U.S. tech companies, including Amazon. So yeah, the French government is putting a 3% digital services tax on every single transaction. And the administration looks like they're kind of backing up our tech companies saying, we're going to threaten 100% tariff on your wine. And that is like their main export, where they make a boatload of money selling expensive wine. What's next here? Soha, what's up? Thanks for being a member. Honestly, I've been in TQQ for 3 months now and I'm up a lot. Yo, I was gonna say, if you've been in it for the past 3 months, you've got to be up a good chunk. I'm just a fan of holding just the actual QQQ, but look, here's what happens in a big downtrend. So if the QQQ falls 30%, which is normal, look what that did to this ETF in 2022. It went from $45 to $8. So it fell 90%. So that's the one thing you want to be careful if the Qs do fall 20, 30%, it's harder to recover that gain. What is this one? Finn says MELI. So this one's interesting, but I know exactly why it is on a downtrend. Hey, what's up, Egg Mayo? Yeah, we'll try and get to be in stock and Reddit too. I'm sorry if I'm behind and missing some of these stocks. What's up, Howard? Like RDW. Are you on Moomoo right now? I am. Yeah, Mark, if you like to get this brokerage, it is called Moomoo. It's where you buy and sell stocks on. I actually have this linked in my profile bio there, where if you sign up with that link, well, it's like an affiliate link. So we'll both get like a free stock if you deposit $100. But yeah, I'm on a brokerage called Moomoo, linked in bio. Anyway, here's MELI. The reason the stock is on such a downtrend, the stock went from $2,500 to $1,500 today, is because of margin compression. Margins are going down. Here's some basic metrics here. Gross margin, that fell 6.5%, and net margin fell 43%. You know what's just funny? The last stock we looked at, the trade desk, we were talking about how Amazon's eating their lunch, coming for their competition. The exact reason MELI is falling is because of Amazon as well. MELI does the exact same thing that Amazon does, but in Brazil and in Mexico. So it's basically South American Amazon e-commerce. And Amazon, as of like a month, or actually it was like 2 or 3 months ago, announced they're expanding a 1-hour delivery service to the top 7 most popular cities in Brazil. So basically, MELI is competing with Amazon again. And so that's why their margins have come down. They have great revenue growth. That's the good part. Super impressed with this revenue growth. I love it. Revenue's at a record, up 49%. So revenue's up 49, but the net income declined by 15. And it really did. That wasn't some one-time adjustment. Like operating profit really did fall by 19. Again, that means margins are going down, which is the one reason why I think the stock is falling. Still, they're nowhere near bankruptcy. They still make over 400 mil of net income a quarter. We've converted it to US dollars, even though all the revenue comes from Brazil, Mexico. It's in USD. Interesting there. But yeah, also, here's the other tough thing. Even on this massive dip, even though the stock is down like 40, 50% the past year, they're still trading, even on this dip, expensive at a 39 forward PE or 39 times next year's net income, which, Amazon's cheaper than that. So, hey, what's up, Matt? Good to see you, dude. He says Visa stock. Yeah, let's do Visa right here. This is one of my favorite companies to buy. It's a nice dividend growth company. Every time, you swipe your credit card, those small little micro transaction fees that we pay are slowly bankrupting us, are making Visa a lot of money, basically to the point where Visa collects royalties. If we go to Visa's net margin, it's literally a 53%. So every time they receive $100, $53 of that is after tax net income for them. So they basically collect royalties. Here, revenue, check this out. Revenue was 11 billion and they kept over 6 billion of net income on that. Yeah, here's the net income every quarter. They're easily making like 5 to 6 billion of net income every quarter. They have a 0.77% dividend yield and they only trade at a 23 times next year's net income, which is what the S&P 500 trades at. And with how they're growing their net income, net income's up 31% year over year, revenue's up 17%, double-digit growth. I'm a fan of Visa. Visa partners with OpenAI to integrate payment network into ChatGPT. So let's do B in stock. Yeah, sorry again. I know I'm a little behind here. What's up, Egg Mayo said B in stock. So then we'll try and get to SKM and some of these other ones. What's up, investing? Yeah, we'll look at ServiceNow. You know what? And actually, after this is ServiceNow. NOW is next. I won't want to get to that one. And we'll get to Celsius and stuff. So here's Brookfield right here. I believe this is an asset manager. They're like a private equity company, and they also own some like infrastructure. But yeah, private equities, 40% of the revenue. Then infrastructure, asset management, energy, real estate. Interesting here. Here's the revenue. Revenue's up 3% after it fell by 21%. So it looks like the revenue is off its peak from 2023. The stock has done very well since 2023. And they're making consistent net income every quarter. Yeah, if you average it out, they make over $1 billion of net income every quarter. And if we look at them on a forward PE basis, there is no forward PE. Or do analysts just not cover it? Yeah, analysts just don't cover this one. Oh, wow, I didn't realize that. Anyway, they're kind of similar to BlackRock, like private equity. Yeah, I guess they're actually headquartered in Ontario, Canada. So this is a Canadian stock. Industry says it's asset management, private equity. Cool. So here's ServiceNow right here. We'll try and, again, sorry, I'm missing some stocks here. So here's ServiceNow right here. It's a software company. Here's why I think this one is also on a massive dip. First off, every software company is. Like if you look at ServiceNow, Salesforce, Adobe, Duolingo, all these software companies are on a massive downtrend. But even on their massive sell-off, ServiceNow still trades at a 43 forward PE. So if we get another huge software sell-off, I could see this forward PE falling to like a 35, a 36, and that would send the stock down another 15, 20%. So just because of that, now's not the time to go crazy. Now's not the time to go all in. Maybe it could be fun to do a small little nibble, but definitely don't go all in. Here's why they also are trading at a high valuation. They deserve a high valuation because they're very impressive. What other company do you see pulling this off? Where literally by the quarter, the revenue hits a new record. So insane top line revenue growth, and they're already net income positive, making a couple $100 million a quarter. But again, that 46 forward PE still might be a little too expensive. So Amazon's a big bully. Yeah, they come for everyone's margin. So next up, oh yeah, I said Celsius. So this is your energy drink company. Hey, what's up, Tengrika? Yeah, we'll do Sphere after this, the Las Vegas Sphere company here, Sphere Entertainment. Yeah, that's a cool one. So this is Celsius though. They have a 28% energy drink market share via Alani. They now own Alani, they own Rockstar Beverage, and Celsius. So those are the three main beverage brands, and they trade pretty fairly. You had an 18.6 forward PE, so you only trade at 18 times next year's net income. And we're looking at next year's net income because they had a one-time adjustment. It says they lost 60 mil that quarter. They didn't actually. They actually made 166 million. They had a one-time termination fee from moving their distribution over to Pepsi. And Morningstar says they're undervalued. Strategic expansion through the PepsiCo distribution partnership and the diversification via the Alani acquisition will drive long-term value growth despite a highly competitive environment because, beverages are like the most competitive industry ever. But I see Alani's everywhere. Hey, Nathan, hope you're well and getting good grades. Hey, thanks, AJ. Hey, it's summer, so I'm not in college right now, so I'm able to stream a little more, which is awesome. But yeah, I start back in August. Do you care for chart patterns? You do mostly look at fundamentals. Yeah, I don't really do like fundamental analysis. Like if something's technically oversold or something. Here's the thing. Like I know if Meta's cheap, I can tell if a company's undervalued in evaluation. I don't know when they're going to go back up though, so I'm not going to wait until like a certain pattern to buy a stock. Or if they're undervalued and I think it's a decent deal, then I'll start buying shares. And I do own Meta. Actually, Tom says Emoji.A. That's actually my most recent purchase in this portfolio in my buy and never sell account. This is an aerospace and defense company, and they actually just hit an all-time high. So this is my way of getting exposure to the aerospace and defense sector. I was looking for a high quality stock, and this one I just really liked. They have over 1,500 patents. They have the whole company is worth $12.9 billion, and they have like a $9 billion backlog of orders. They have basically, they have pricing power. And here's where the revenue comes from, space and defense, industrial, which are data center cooling pumps, commercial aircraft, military aircraft. So basically, the point is, if we look at revenue, the lifeblood of the company, the revenue's up 12, but the net income is up by 49. The net income growth rate is much faster. That means margin expansion. Net margin went from a 5.8 to a 7.8. Nice little bump up in margin there. Pretty cool. I'm wondering, when you analyze stocks, do you only read financials and earnings report? What's your strategy? Well, it's actually kind of like a combination of things. Like, there's so many factors I look at. And for me to really own a stock, I'll do way more additional research on a company than just what I do on my stream. But basically, these quick little analysis I'm doing on stocks, I do kind of cover the most important metrics that I do look at when analyzing a stock. Reddit, please? Okay, we'll do Reddit. Sorry, I'm a little behind here. What's up, Trap? I see SRPT and some of these other ones. So Reddit is a really cool software company, but they also are they have like $100 million contract with Google, where Google pays them $100 million a year for their data to train their LLM. So Reddit just has high quality data, and they also are a huge advertising company. Morningstar says they're undervalued. Highly engaged user base with specialized communities, combined with AI-driven ad targeting capabilities and emerging data licensing opportunities for large language model training, will drive long-term value growth. They say Reddit's a $200 fair value. Honestly, Morningstar is pretty cheap. I mean, they're trading at a 30 forward PE, or 30 times next year's net income, and that's not even doing an X cash PE multiple. What takes a lot of risk off the table is the fact that Reddit literally has $3 billion of cash and zero debt. Unleveraged balance sheet. They did 200 mil in net income, 250 mil last quarter. And look at these year-over-year growth rates from the previous year. So very fast net income growth, very fast free cash flow growth, the fastest ever net income and free cash flow growth. It's because of this recent LLM licensing opportunity that they've had. So anyway, I do own Reddit, full disclosure. I am a shareholder. I got 5 shares in them. And it's also one I bought just literally like on the dip. Yeah, look at Reddit was no exception from the software sell-off. Reddit went from 264 all the way down to 119. And that's where I bought a share at like 125. I bought an additional share of Reddit, and it's done pretty good since. But yeah, they also if you're in advertising or want to advertise on Reddit, your return on ad spend is better on Reddit than on Meta and Facebook. So you're basically guaranteed a better profit by spending your money on Reddit ads than like Meta, as they're just now introducing their ads. Yo, dude, Lab, what's up, dude? We literally just looked at AppLovin not that long ago, like 5 minutes ago. If you want to check that out, you can rewind it on the YouTube stream. Just type into YouTube Nathan Robert. But if you give me like 5 minutes or so, 10 minutes, we'll come back to AppLovin. But basically, this is another super, super high quality software stock, just like Reddit, that whenever we get another software sell-off, these are the best ones to buy. AppLovin, Reddit, Uber, Microsoft, I'm kind of staying away from Adobe. I'm staying away from Duolingo. Of all the software companies, I want to buy the ones that, I don't think are going to get too hurt by AI, which is AppLovin and Reddit. Actually, if anything, they should benefit from AI potentially. So RDW. So this is a drone company, I believe. Is there any news around this stock? SpaceX IPO suggests capital migration from smaller space stocks. Fugazi Research publishes a short report criticizing Redwire's governance and financial structure. So I guess there's a short report. How much of the shares are being shorted right now? Oh, wow. So there's a real bear case. 18.5% of every share that exists are being shorted right now. This is one of the most shorted stocks in the market. So, let's see if we can figure out their thesis. So they're a $2.85 billion company. Here's the tough part. They lose a lot of net income, 76 mil, 85, 42, 95 mil. So that's the one bit of bad news. They're nowhere near close to profitability, but they do have good revenue growth. If we zoom out, their revenue is growing very fast, but this revenue growth is actually artificial. They actually acquired a company back here. That's why the balance sheet changed rapidly out of nowhere. They had a very leveraged balance sheet, but then they basically did this acquisition that made them look less unleveraged. But anyway, I would be careful with this one because there is no forward PE. They're very far away from making any sort of net income. What about free cash flow? Yeah, they lose free cash flow every quarter. They lose net income every quarter. So that's what makes it a tough sell for me. And also, there's a ton of also similar stocks that are aerospace and defense, drone tech. There's other stocks as well that are on a similar dip. This one is on a massive dip right now. There are other ones that are also on a massive dip, and they actually make net income and free cash flow and, have great fundamentals. That's why, again, back to when I was talking about the software sell-off, when the software sell-off happens, don't buy the micro caps that just are terrible. If you're going to buy a software company on a 50% dip, buy one that has great margins and great financials. All right, let's see. Brian Paul, what's up, dude? Good to see you. He says, I love ASML. Let's check it out. ASML stock. This is the lithography company, basically making the chip making machines. They have three main customers. It's Samsung, Taiwan Semiconductor, and Intel. And all three of those companies are doing freaking amazing. Taiwan Semiconductor and Intel and Samsung stock are all at an all-time high. Samsung's at an all-time high on this memory shortage. ASML denies selling EUV lithography equipment to China amid U.S. concerns. Yeah, the U.S., this is such proprietary data. The U.S., like China was trying to smuggle their chip. Literal, like FBI and Army came to stop China from getting access to their lithography machines. These are the chip making devices. ASML expands production. Anyway, this is basically picks and shovels semiconductor play. If we go to their net income, it's very good. This is a European company, but we have converted the currency from euros to USD. They really do make like 2.5 to 3 billion of net income a quarter. And check out these year-over-year growth rates. So they're growing their net income as well. So they're not just at all-time highs right now on momentum. They're at an all-time high right now because the fundamentals have genuinely improved. You also get a nice dividend, looks like a 0.5% dividend, safe payout ratio. But at a 49 forward PE, it does look a bit, it's a tough risk to reward buying at 50 times next year's net income. Morningstar says they're overvalued. While the robust AI-driven semiconductor demand in its monopolistic position in EUV lithography will drive long-term value growth, the current market price already embeds excessive optimism, requiring some caution. So yeah. What app do you use? Hey, this is actually a brokerage. It's actually like where they ask for a lot of information so you buy and sell stocks. But if you'd like to get it, actually, it's called Moomoo. You can type that into the Google or App Store. But if you want to use my affiliate link, check out my link in bio there for Moomoo. If you end up depositing $100, we'll both get like a free stock. All right, so Reddit, I think, will fall back to 135. Hey, that'd be a great opportunity. Exactly. That's why, especially in this high volatility market, now is not the time to spend all your cash and have no more money left over. If you want to buy a new position, you want a new position, you slowly dollar cost average into it. Like if you want Netflix is 5% of your portfolio, don't make it 5% of your portfolio today. Only make it 1% and then buy more only if it falls 5 to 10% more. Of course, none of this is financial advice. So Brandon said, can you do CEG? Yeah, dude, this is my very favorite utility company. And yo, Jackson Hoover, yes. Oh my gosh, I forgot about Sphere. Robinhood stock is next, and then SPHR. I apologize, I'm a little behind on the chat here. Thanks again for the 20 goats and gifts there, Jackson. So here's Constellation Energy. I do own this one. I've looked at every utility company that exists and literally all of them that exist. And out of all of them that exist, CEG is my genuine favorite one. It's the purest play for nuclear energy. They literally own over 30% of all the US's active nuclear reactors. So it's the purest play. There isn't even a close second. And they print net income, print free cash flow. They're trading at 21 times net income. So fair valuation. I'm still up 33% on my position. If you're a fan of the companies that are powering data centers, clean energy, nuclear, check out CEG. It's my favorite one. They're still up. They IPO'd or were spun off from Exelon to get away from their nuclear exposure, and they've done great the past 5 years. All right, so yeah, it's tough to be bearish on CEG. I really think we're close to a bottom on this one, especially because, yeah, they're at a 22 times net income. So, hey, what's the ticker symbol for Samsara? What's up, Circle Cow? You give me the ticker symbol for that one. We'll check it out. So let me do Robinhood, and then we'll do SPHR. So here's Robinhood. This is a brokerage right here. And hey, we were just on Robinhood. I have the Robinhood app. I have the Robinhood brokerage. Oh, he says resolve stock. Well, here, I'll be quick about Robinhood then. Anyway, this is a company where it used to trade with Bitcoin. A lot of the reason, or the main reason why Robinhood fell from $150 to $60, it fell 50%, is because Bitcoin in the same year also fell 50%. you didn't know it, or if you haven't looked at Bitcoin in a while, Bitcoin is legit down 50% from 1 year ago. You know, it's 123K, now it's 64K in just literally 4 quarters. And a lot of Robinhood's revenue comes from crypto transaction revenue. Check this out. If we go right here to crypto trading volumes, this is also why the stock's falling. Their crypto trading volume are down 39% year over year. But I've been saying, instead of buying Bitcoin, in my opinion, buy Robinhood. I think it's going to decouple from Bitcoin and rally up even faster and higher than Bitcoin will. And that's because of something called prediction markets. And this is what's really propping up their earnings recently. So I'm not a fan of doing these, but because, you know, it's pure speculation, I'd rather invest in a stock. That's a better risk to reward than doing these prediction markets. But basically, Robinhood disclosed whenever you buy and sell a prediction market contract, they keep a 2% fee, a 2% margin. And whenever you buy and sell a stock, they only keep a 0.1% margin. So these prediction markets are literally 20x more valuable for their bottom line. That's why every brokerage is getting into prediction markets, because they make so much money for their company. But anyway, if we go to Robinhood's net margin down here, they legit keep 30 to 40% of every dollar that comes in. They have 30 to 40% net margins. I love Robinhood. But the tough part is a 52 forward PE does imply that it is definitely expensive at 52 times next year's net income. But I love this one. It's like such an innovative fintech brokerage app. I also love Futu stock, FUTU. So here's SPHR. This is Sphere Entertainment. And then we'll get to RZLV. I don't know what I just clicked right here. This looks like some new chart feature. I have never seen what I just clicked right here. I've never been on this screen before. That's kind of interesting. Anyway, here's Sphere Entertainment right here. This company, if you've heard of like the Las Vegas Sphere, it's like those spheres with LED on it, those LED spheres. This is the company that owns that. I think like a UFC fight was in one of these. So yeah, they have like these really cool shows. I was so close to going to one of these, but like the tickets were like $150, like for the cheapest one. So I'm like, well, maybe I won't buy a ticket. But I really want to go to one of these. Anyway, this is like a better movie theater play. So Madison Square Garden Networks and the Spheres. Anyway, the stock's done great. So I actually would not buy this stock after it's had such a massive rally. You know, there is no forward PE yet, but very interesting one there. Maybe like a leisure hospitality play. Better play than maybe a traditional, you know, movie theater. So, shoot, what stock did I want to look at next? I have no clue. Well, we'll just look at what y'all have in the chat to say. What's up? Will InnoData continue to... Oh, RZLV, that was it. Resolve AI. Thanks again for the 20 gifts there, Jackson. Then we'll get to some of these other ones. Resolve AI, I don't know about this one right here. Because do they have revenue? Okay, so they basically are getting their first ever sort of revenue. They don't break their numbers down quarterly, which means they're not a US company. Yeah, so they're not a US company. They're headquartered in Greater London. So it looks like some London Exchange AI company, Resolve AI. And for the full year 2025, they did 46 million in revenue, but they lost 100 million on that. That's the one tough part, because historically they have a very like leveraged balance sheet. They issued 200 million of shares that year. Yeah, so I don't know. You're basically going to watch the revenue growth. So that's really what you want to watch, because they have this amazing top line revenue growth, but the profitability is still an issue. Yeah, actually, let's go to their website. Maybe I wish I could give you more thoughts on this company, but I can understand why the stock is struggling. AI that transforms commerce from search to checkout. Strategic partnerships include Microsoft and Google. Okay, so here's kind of their pitch. So 10% plus online revenue when you use us. You'll get a plus 8% average order value, plus 17% add to cart. So I guess customers wait 5 minutes less than in stores. So some sort of AI e-commerce shopping company. So let's check out IoT right here. This is Samsara stock. So they are off their peak. You know, a year ago they were $60. Now they are $30. So they're 50% off their peak. What do they do again? I completely forget. So software infrastructure, headquartered in California, it combines plug-and-play sensors, wireless connectivity, and cloud-hosted software integrations for deployment. Huh. Cameras and videos, well, that's kind of a commodity. Weather alerts, AI detections, 360 visibility. These like cameras or something. I don't know. I'm trying to understand this one. You know, definitely something you'd want to do more research on if you're trying to understand what this company does. But some sort of software company. Let's check out revenue right here. So revenue is very impressive. So the stock's 50% off its peak, but judging by the fundamentals, I don't know why. So revenue's at a record right now, up 30% year over year, and they actually made net income for the first time ever. Yeah, if we zoom out for all of history, they've genuinely never made money before, but for the past 3 quarters in a row, they've actually made net income. What are the projections in the future? Yeah, wow. The orange line is what the analysts project every quarter. Notice how they beat on earnings. The blue line's what they actually report. In the next 2 quarters in a row, they expect them to stay net income positive, 5 million, 17 mil. And if they keep beating by this chunk, this is real, even on earnings before interest taxes, EBIT, they genuinely beat by a good chunk every single quarter, even on revenue. So honestly, there must be some reason. I don't know why the stock is falling. Maybe it's AI prone. Maybe this can get vibe coded away. I genuinely don't know. Maybe it's more AI prone than I realized. Markets will be lower on Monday. Check this out. If we go to the S&P 500, we do actually get the 24/7 futures. Here's the S&P 500. S&P 500 right now. It's only down 0.19% from Friday's close. But, there's low volume, so we don't know. Guess we'll wait till tomorrow night. By the way, if you wanted to follow button, we're going to be streaming tomorrow. Sundays are my biggest live streams ever. We normally don't stream on Saturday, but every Sunday we do 2 streams, one at 12 p.m. Eastern, and then one at like 8 p.m. Eastern when the stock market opens, the overnight market. So TIGR has had a big fund buy. Yeah, so this is actually, I'd rather buy Futu, but this is one of the international brokerages that also got fined. So they got fined by China for allowing their Chinese customers to buy US ADR assets. Lin discloses 10.9% stake in Up Fintech. So that's this company right here. So what's cool is the risk to reward looks super fair on this stock because of the valuation and because of this China sell-off. They're trading at 6 times net income, legit, extremely cheap. And here's some data we get. Paying clients went from 1.15 million same time last year to 1.28 million paying clients. So they're really growing. Their most valuable metric to paying clients. And again, they just paid their fee right here. That's why the net income went negative right here. It wasn't actually negative, but they had to pay their one-time fee. Anyway, very high margin brokerage right here. So just like Futu. Futu is a better fundamental one though. But yeah, TIGR and FUTU seem pretty good. I don't know if... See, the thing with Up Fintech is, I don't know about Up Fintech. Do they I know what I like about Futu is a lot of their exposure is actually in like the United States. I love their United States asset brokerage business, which is the app I'm on right now, Moomoo. I don't know if Up Fintech has any US assets. I just don't know. So Trevor says Amazon. Yeah, dude. Amazon is one of the best buy and never sell stocks. You can just trust this one. You can sleep well at night knowing nothing bad's going to happen to Amazon over the long run. It's like an ETF in one. It's an e-commerce play, subscription model play, grocery store play, robotics play, AI play, cloud play, space play, satellite play. So the most valuable part of Amazon is actually their AWS, Amazon Web Services. It's the highest margin business. Whenever they ship you a package overnight, they're not keeping, they have a very low single digit margin on that, but their AWS is over 30% like net margins. And that business does over 130 billion of annual revenue for them. So Amazon has really been a margin expansion play. They're also the world's #1 company by total revenue. No company does more revenue than Amazon. It does 750 billion a year. And check that out over time. This is why you can trust Amazon. Literally, like by the quarter, the revenue hits a new record. And not just revenue, but profits as well. They're the most profitable they've ever been. So if we just go to net margin right here, net margin metric right here, in 2022, this was a tough buy. They had like low single digit margins, sometimes negative net margins. Then it got a respectable 5, 6, 7% net margin. Now it's like double digit net margins. So anyway, and there's always a ton of news. Amazon's getting into AI chips. They're literally selling TPUs. Amazon invests $10 billion into Missouri data center. Amazon in talks to sell custom TPUs to external data centers, challenging NVIDIA. So Titanium chips launched in 2020 and are currently being used by OpenAI, Anthropic, and Uber through AWS, generating over $225 billion in revenue. The chips are largely sold out with strong demand expected for fourth generation chips in 2027. So selling their own chips. Amazon launches cybersecurity platform, AI computing costs declining by orders of magnitude. Amazon pilots warehouse system expected to cut 7 million labor hours annually. Anyway, yeah, Amazon deploys 36 satellites via Airlane 6 rocket. Skyward opens reservation for LEO satellites. So U.S. Homeland Security awards AWS $2.6 billion cloud contract. Anyway, I could go all day and talk about Amazon. And the thing is, Amazon only trades at a 29 forward PE or 29 times next year's net income. And yeah, they're getting into less than truckload trucking as well. Pretty cool. What is this app? Yeah, hey, Riemann. This is actually a brokerage. It's where you buy and sell stocks on. It's actually linked in my bio, LinkedIn profile there. Or you could type it into Google. It's a brokerage called Moomoo. Hey, my music says, Nathan, that forward PE for ServiceNow you have on Moomoo is not what I'm seeing. Forward PE is a 23. It's actually not a 23 forward PE, and I actually double-checked this. I remember someone was telling me about this earlier. For using websites like Stock Analysis said ServiceNow is trading at 23 times forward PE. That seems really cheap. You know, the risk reward would look very good on ServiceNow if they were really trading at 23 times net forward PE. But right here, this app says they're at a 43 forward PE. And actually, you know what? I'll pull this up. Stock Analysis actually uses non-GAAP EPS numbers. It's so weird. And I even triple checked this because I didn't believe it. And other websites do this as well. Why would they use non-GAAP EPS for software projections that do heavy stock-based compensation? Basically, point being, it's going to be hard to see. But here's ServiceNow. Where's forward PE? It should be over here. Yeah, here's what morning ServiceNow, or they say ServiceNow's at a 21 forward PE. That's not right. And here's how you can tell. Well, I was checking it as well. The metrics say they literally disclose themselves to use non-GAAP EPS. So point being, those websites are wrong. Is Innodata done or will it continue to grow? It will continue to grow, but it is at the point where you can't buy the stock unless it falls 10%. You know, I am super bullish on the future, but I am super bearish on buying shares today. You know, I already own this stock. I owned it before this huge gap up right here when they got the Palantir $50 million deal. This is another one where if a software starts to crazy sell off again, I would check out Innodata as one to potentially add to your portfolio. Revenue grew 54%. Net income grew 91 to a record, excluding the one-time adjustments. So, CEO or CFO reaffirms 40% revenue growth guidance. Wow, 40. So look, for the full year 2026, they're projecting another 40% annual growth. Full year 2025, revenue grew 47% from 2024. From 2024, it grew 96% from 2023. So they're just on a streak of growth. That's what I want. Companies that grow, companies that have a no net debt, companies that make net income and free cash flow. And Innodata does all that. They're already net income and free cash flow positive. Actually, if you didn't know, 5 of the Magnificent 7 are customers. Google, Amazon, Meta, Microsoft, and NVIDIA are all customers of Innodata. The only ones that aren't is Apple and Tesla. And Palantir just signed a $50 million deal. That's why they actually gapped up on this day right here from that new $50 million contract deal and improved guidance. Hey, what's up? We'll look at a few more here, then I gotta run. I appreciate everyone that's on the stream, though, on YouTube and TikTok. If you're enjoying, please leave a like and follow. That's the only way to support me. I sell literally nothing. I have no course, book, WhatsApp. I'll never follow you, DM you. Just on your giving my opinion. So here's Fidelity National Services. So this is like a banking app, brokerage. I suspect they're kind of just being out-innovated because I don't know if anyone or the people use Fidelity, or actually no. So most of them are banking solutions, not like a brokerage. So banking is 72% of all the revenue, and they trade at 11.3 times net income. And that's after this massive dip. So even though they've fallen like literally 80% from its price in 2022, went from $150 to $38 in just 3 years, they're trading at 11 times forward PE. That's like the same valuation JP Morgan trades at, and JP Morgan's at an all-time high. Or, well, it's not super close, but if we go right here, JP Morgan trades at a 14 forward PE. And Fidelity is just like a little bit cheaper, but they're on a 50% downtrend. I don't know. That's one I don't know about them. I don't even know if that's like the main Fidelity Corporation. But I'm just staying away from that one. But I do like the financial tech software. Or I don't know if they're just being out innovated by like fintech apps like SoFi or Robinhood. Would you put 5,000 in Amazon or Microsoft right now? Well, at this exact moment, you know, I wouldn't put 5,000 into either of those. I'd dollar cost average it disciplinedly, but I would buy both of them. Right now, if I literally was just forced to pick one, I would pick Microsoft. But if Amazon, Amazon's so great though. Honestly, I probably trust Amazon more than Microsoft long term. But just short term, I don't know. Both are good. It depends, it's all in your own portfolio. And which one do you want to build up more? Bought 1,000 shares of SMCI at 28. Then the backlog did give a pop. SEC filing. Yeah, Super Microcomputer. Oh, you bought at $28 a share. Nice. So it is $30 a share. Basically, the reason Super Micro just gapped down is because they just diluted shareholders by $7 billion. And the whole company is worth $19 billion. So $7 billion of $19 billion is a good chunk of the whole company. But they did it to fulfill their backlog or something like that. Look at Kroger earnings. So I heard Kroger is struggling for two reasons. It's consumers are, with high oil prices, they're like spending less money. There was another reason though. Oh, SNAP. Oh, I was just reading this. SNAP restrictions. These new SNAP restrictions take away on average. Yeah, it's very in the middle of my screen. Research firm estimates restrictions could reduce food and beverage sales by as much as $830 million just this year as consumers either shift spending or to approved products or cut back overall. I don't know, some sort of SNAP changes. And they said their consumers are struggling right now because of oil prices. But still, Kroger's risk reward looks pretty fair. Warren Buffett's company owns this. They're trading at an 11.2 forward PE or only 11 times next year's net income. They buy back so much of their company a year, like it's crazy. So net income grew by 4%, but net income per share grew by 13. They really did buy 9% of all the shares back in the past year. Fortunately, all those buybacks might have been poorly timed because they're down 8% on the day. But anyway, Kroger's interesting. A nice dividend growth stock. You buy a share of Kroger right now, you're getting over 2.5% of your money back just in a dividend every year. But also, Kroger might be getting out-innovated right now. Like if you love Kroger, I'm pretty sure anything you can get at Kroger, you can get on Amazon, and Amazon will deliver it for you. If your cash position is greater than 5K, I don't see a problem buying Microsoft. Great projected net income, P is attractive. Yeah, I totally agree. The risk reward on Microsoft is super, super fair. And that's one I've been loading the boat on. I'm only up 5% on my shares. Yeah, 21 forward PE, and you get a 1% dividend yield. You don't get a dividend with Amazon. So maybe if you like income, can you do PSIX? So yeah, PSIX right now. I do own this one as well. I am down bad on this company. So they are down for a reason, and that's because of margin compression. So yeah, here's my position. This is a stock I've always, recommended having as a super small position if you wanted this one. Like if you've ever wanted this stock, you never would want to trust a meaningful amount of money in this stock right here. Oh yeah, we'll do Oracle next after this. And a few more, then we'll look at a few more here. Then I got to go. But yeah, Power Solutions right here. I do own this one. And here's the main reason they're struggling. If we go to revenue, the lifeblood of the company, the sales, it actually declined 5% year over year. So revenue is negative. And not just the revenue, but the net income. The net income fell by 50% year over year. So if we go to gross margins fell by 20% and net margins fell by 50. So there is a real justified reason for this stock to be hurt so bad. But here's also the cool part. The worst might be priced in. This is a $929 million company. So the whole company is worth $900 million. It's a microcap. Out of all the companies worth $900 million, I at least want to make one that makes like millions in net income every quarter. But also, and I used to like this one a lot because it had a lot of growth. It kind of changed the story now because maybe we're experiencing, the growth story's gone. Maybe they're going to decline more of their revenue. Maybe margins will continue to fall. Who knows? So that's something to maybe look more into. But yeah, what was their valuation? Even on this dip, they're trading at a 15 forward PE. So maybe the worst is getting close to being fully priced in. What time tomorrow? Hey, I'm streaming at 12 p.m. Eastern time tomorrow. So let's do Oracle right here. This is like your third or this is your fourth largest market share of cloud. So number one cloud market share is AWS, then Azure Cloud, then Google Cloud, and then it's Oracle. And this is a pure cloud play because whenever you buy any of those other three cloud companies, you're getting other businesses. Like with Google, you get advertising in YouTube. And with Microsoft, you get their software business. And with Amazon, you get all their other retail businesses. But Oracle, it is a pure cloud company right here. And one thing that's sorry, my dog. Anyway, one thing that is scaring investors right now is how much debt they're taking out right now. Basically, they have to spend an insane amount of money. So if we go to their, long-term debt right here, they have 150 billion of debt now. Here's the thing. They're spending so much on CapEx. Here's the CapEx numbers. They spent 15 billion this quarter, 19 billion last quarter, 7 bill, 8 bill, and they just projected they're going to spend like 15 billion for the next 4 quarters in a row. The bad part is they're only making 3 to 4 billion of net income a quarter, excluding this one-time adjustment. So they make 4 billion a quarter and they're spending 15 billion. You start to get the idea of why they have so much debt now. So they're also in the income statement, you can see the interest expenses. So just that 150 billion of debt cost them in just interest. Look at that year over year, 1.44 billion of interest. That's like the cost of the dividend. By the way, Oracle pays a dividend. Their dividend cost 1.5 billion. They pay the same amount in interest. And actually, the yield is a 1.1% dividend yield. That technically means they pay 1.1% of their entire market cap in just interest a year. Anyway, it could be fully, the tough part is, I like Azure Cloud better, and Azure Cloud trades cheaper. Amazon's at like a 27 forward PE, Google's at a 27 forward PE, Microsoft's at a 22 forward PE. This one just isn't my favorite cloud play because of the debt, and I don't like their dividend payout ratio. So that's the one part. Morningstar says they're reasonably valued though. The booming demand for AI cloud infrastructure and mission critical database products will drive long-term growth. The massive capital expenditures required for data center expansion and high customer concentration prevent notable risk that require caution. So yeah, if we go to free cash flow right here, very free cash flow negative because of how much they're spending, negative 2 bill, negative 11, negative 10. But they have this like $200 to $300 billion backlog of orders, and most of it, like 200 billion of that backlog, is literally just from OpenAI. So that's that concentration risk. But it's still interesting. So Mr. Smith and said SHLD's ETF. He says, I think is Think Thing ever going to go back up? Okay, I think. You mean, is this ever going to go back up? Honestly, I love this sector right here. I think this ETF is being weighed down by Lockheed Martin and Raytheon. Because if we look at GE Aerospace, which actually, very weirdly, GE Aerospace is not in its top 10. GE Aerospace should be in its top 10 because that one's at an all-time high. But yeah, if we go to its largest holdings, like Raytheon is off its peak, Lockheed Martin is still a good chunk off its peak. And so the ETF is just following that. But here's why. Honestly, I like the aerospace and defense sector. And this ETF, diversifies your money up for you. So if you don't know which one to buy, like Raytheon or Northrop Grumman or Palantir, this ETF just diversifies your money up for you into the sector. They do have a 0.5% expense ratio fee, but that's reasonable. Honestly, I'm also a fan of just picking and choosing my own aerospace and defense names. Like Raytheon, I would happily own this one. They have a 1.5% dividend yield. GE Aerospace and Moog are the ones that I've been looking at. So GE Aerospace actually just hit an all-time high. And also, not just GE Aerospace, also Moog, MOG.A. So these are other aerospace and defense companies I really like. But yeah, that sector I really like. Raytheon has got to be like my top pick. This is like, instead of owning the war, own the people who sell the bullets. This is the picks and shovels play. They sell the missiles, the bullets to the government. Like, you ever see those clips of like them shooting like a machine gun in the air and it says like minus $5,000 or every bullet they subtract money? Like, it's the picks and shovels play. And especially if warfare start to escalate, these aerospace and defense companies should just benefit. Now, but Gap also includes massive acquisitions of Armis. Hey, my music, actually, are you in my Discord and did you mention that? I actually replied to you in the Discord with like a full deep dive analysis on why. Like I hear what you're saying. It includes the massive gap one-time adjustment. The forward PE is nowhere near 23, sadly, on ServiceNow. And I triple, double, quadruple checked. And we can even see the S&P Global Net Income Analyst. We even saw, we looked at their old previous analyst EPS, and it was using non-GAAP EPS too. And it says from that website, it says they're projecting, stock analysis was projecting 900 million of net income for the next 2 quarters in a row. That would be ridiculous. They are definitely not going to make $900 million the next 2 quarters in a row. That's what stockanalysis.com is saying. And here's the net income forecast from S&P Global Analyst. So, oh, well, you know what? That's funny. Then someone else to mention that in my music. But anyway, we were looking at it exactly, literally from stock analysis. They were projecting net income and it was non-GAAP of over 900 mil for the next 2 quarters of a billion. Okay, so hey, if you want to join the Discord, by the way, it costs $1. I only made it $1 because I don't want any bots to be in there ever. Or if you're a YouTube member, you also get permanent access. Like if you're a YouTube member and then you cancel your YouTube membership, you still stay in the Discord permanently. Or you can pay a $1 one-time fee. It's linked in the YouTube description. All right, we'll look at 1 or 2 more stocks here, and then I got to run. I never like to promote the Discord because, I literally sell nothing. I have no course book, WhatsApp, Telegram, literally nothing. The only thing I have is a $1 Discord. All right, simply to prevent bots. You only join it if you have a question for me or something. What's up, Pork? He says, last week was a whole loss week for me. Dang, really? The S&P 500 did pretty decent, but that's why also, the average retail investor, hedge fund, institution literally cannot outperform the S&P 500. So if you can't beat it, I promise when you underperform, not if, but when you underperform the market, you'll feel a lot better if you at least own a little bit of the S&P 500. And no, trust me, if you think, no financial advisor would call you crazy if you called him up and said, "Hey, I just bought the S&P 500." He'd be like, "Great. Historically, that's the best way to beat inflation." The S&P 500. Pathan PD. PD. What is PD? Oh, PagerDuty. Also, Procter & Gamble is a cool staple company. PagerDuty, this is a very small one. They're worth only $650 million. So that is a very small market cap. They're trading at a 13 times next year's net income. So this must be one of the software companies that might be getting hurt by AI. They're in the ARC portfolio. It's a digital management platform. So PagerDuty, ship faster, resolve smarter, and sleep better. Hey, I'll take the sleep better part. So they're trusted by 70% of the Fortune 100 companies. Looks like they got some real customers, and here's kind of their pitch. So 59% reduced disruptions, 27% more productive teams, something like that. Anyway, I've seen a lot of stocks with like websites like this, and some of these like trade cheap. What are the other, like, I'm blanking, but we just looked at like 2 of them like 20, 30 minutes ago. There's software companies very similar to this. I can go down the line right here. What was it? Maybe it was FIS. I don't even remember. Anyway, it looks, the revenue growth did start to slow down. So that's one thing you want to watch out for. Maybe that might be why the stock is struggling right now. If we look at the revenue, the lifeblood of the company, the sales only grew 0.9. That doesn't exactly beat inflation when the revenue is only growing 0.9%. But the profits, they are the most profitable they've ever been. All of history before today, they've lost money every quarter. Now they're actually making a couple mil every quarter, and to the point where they're only trading at 14 times next year's net income. All right, so let's see. BBAI. So I don't even know what this is. BBAI. Like I've analyzed the stock like 10 times, and I still couldn't tell you what they do. But let's see. I know revenue remains stable, supported by the Ask Sage acquisitions, higher margin generative AI platforms, offsetting the decline in U.S. Army programs. So I remember analyzing this stock a year ago. They had like this U.S. Army revenue. That was like most of the revenue. But now it's like, so they just acquired something called Ask Sage. So I don't know. So here's the not good part, the net income forecast. They're supposed to lose 22 mil next quarter and 22 million the quarter after, but the revenue is supposed to grow to 39 million, potentially artificially from the acquisition, but they're a $1.88 billion company losing around 100 mil a year, or actually probably like 90 million a year, which isn't too big of a difference. So here's their website, Mission Ready AI. BBAI fuses artificial, okay, well, it just removed what I was reading. Okay, so Shipyard AI, advanced shipyard analytics and simulation platform. You know, something to definitely do some more research on. Looks like the U.S. Army is part of the revenue, and BBAI shareholders approved doubling common stock to 1 billion shares. So, is that to do an acquisition or something? I don't know why they. That's a lot of dilution. So just be careful with that one. So, yeah, I saw a few people ask for BBAI. I wish I could give you like better thoughts on this company, but I don't know. Guess there's some comments, but yeah, sorry. So, what is this one? CRS doing good. Oh wait, actually SRPT. Sorry about that, Vinny. I wanted to get to this one earlier, but I remember this one because if you're wondering why is this stock gap down so crazy, it's because they sell a prescription and there was a malfunction with their manufacturing and a couple people unfortunately passed away, and that's why the stock completely utterly tanked. So I wonder if we can find some additional context on that. Morningstar research, so Morningstar doesn't cover this one, dang. But that's the only thing I remember, that they gapped down because of, and I don't even know exactly, it might have been over 20 people. But anyway, collaboration revenue looks like that just spiked up like crazy. Oh yeah, so this might be it. So Elevides, that's down, the sales of this are down 72% year over year. This phosphorodimerate revenue is down 3%, but this other collaboration revenue is up 200%. So when we combine all the businesses together, okay, the revenue still fell 1% year over year. Anyway, you probably just want to look for additional context on what happened. So it's a commercial stage biotech company. Hey, what's up, Steven? I'm doing good, man. How about you? Yeah, I normally don't stream on Saturdays, but I thought, hey, why not do a quick little stream? If you're enjoying it, please drop a like for me. Now updated 2026 guidance is adjusted. Yeah, see, I don't believe ServiceNow is going to do $1 of EPS a quarter. See, I remember how they said they're expecting $4.12 for the entire year of EPS, my music. The EPS has never been close to, that means over $1 of EPS a quarter. So that would mean for the next 4 quarters in a row, there's going to be 100% EPS and net income growth. And I just don't know about that. So, all right. Next up is S&P Global. They have a shared monopoly with Moody's. So they have a credit rating business. If you ever like see bonds and certain debt, it's like rated like AAA or BBB or junk bond status rating or etc. S&P Global, Moody's, and Fitch are the ones that basically it's a shared oligopoly, the industry. Morningstar says they're undervalued, highly entrenched data-driven benchmarks, robust pricing power, and expanded AI-driven efficiencies will drive long-term value growth. And they're only trading at a 24 PE or 24 times next year's net income. Yeah, most of the revenue are 32%. The largest segment is their credit rating business. And also, you see this app I'm literally using right now, this brokerage, they get all their data from S&P Global. They have this data analytics business. So literally all this gap data we get, operating profit, net margin, all this comes from S&P Global. So this app I'm on, this brokerage, pays S&P Global for that data, which is pretty cool. And I think Webull might as well also pay S&P Global for it. Anyway, it's just a quality company. And I don't see AI replacing this company. I don't see AI coming for the credit rating business. I mean, maybe AI can credit rate stuff better than people one day, but I don't know. Plus, you get a nice dividend of over 1% of your money back in a dividend every year. All right. Yeah, but are you looking at GAAP or adjusted? Yeah, GAAP EPS, the one that includes stock-based comp, which is the important metric, because I don't want to look at a metric that projects $1, because that's not the right metric to look at for software companies that do heavy SBC. So I always like I never like see I'm just super strict with how I analyze stocks. I never give companies the benefit of the doubt. I want the metric that includes the stock-based comp because a lot like companies right here like they can have incredible free cash flow. Like actually Roblox is the perfect example of that. And if you look at non-GAAP EPS, it's different as well. So Roblox right here, they print free cash flow. They made 600 million of free cash flow, but when you go to net income, they lost 200 million of net income. How'd that happen? It's because of a metric literally called stock-based compensation, where they pay their employees with stock. They include that as a negative net income to the GAAP metrics because you would have had to pay an employee with money instead. So and it dilutes you as a shareholder. So I'm glad that I just don't like to use the benefit of the doubt. I always use the most strictest number. What do you think of short term for Nvidia? Yeah, short term, it's definitely tough to be bearish on Nvidia. Actually, short term it's undervalued, and long term it's undervalued too. Honestly, like most people might call me crazy. Like this chart right here, they're basically at an all-time high right now. Here's why they're honestly pretty inexpensive. They trade at a 21 forward PE or trading at 21 times next year's net income. That is not peak bubble valuation. You know what I mean? Like we're not in a bubble right now because valuations are still fair on the top weightings of the S&P 500. Nvidia is the literal largest holding in the S&P 500 and they're at a 21 forward PE. You know that in the dot-com bubble, we were seeing forward PE ratios on like Cisco and stuff right now in the like hundreds, like crazy forward PE ratios, but they only trade at 20 times next year's net income. So, and like Google's at 27, Meta's at 21, Microsoft's at 20. Like literal the top weightings of the S&P 500 are fairly valued, and that's why I think the S&P 500 can just continue to climb higher, especially like the market's been propped up. The S&P 500 has been propped up from hardware stocks like Intel, AMD. A lot of these hardware stocks have been doing really good. And what hasn't done good recently is software and fintech like Robinhood, SoFi, and ServiceNow. If we start to see a recovery in software and fintech, that could just send the market even crazier to all-time highs. We're in like the next roaring 20s all over again. Have you ever used Thinkorswim? No. What's up, Ben? I thought you were going to sleep. Yeah, dude, I need to go to sleep. All right, one or two more. Can you please do CRS and HPE? All right, sorry. Yeah, let me try and get to these again. Sorry if I'm behind and I missed some stocks here. We're gonna do a lot of like over like probably 5 hours of streaming tomorrow. So here's Carpenter Technologies. Congrats if you own this stock because they are at an insane new all-time high. So if you've ever bought this stock, you're definitely up on your money. It's got to be some sort of so they're a medical fabrication company. It manufactures specialty alloys. And I'm assuming these specialty alloys are used by data centers or something like that. Leading innovation, excellence, value creation. So they're in aerospace, transportation, consumer, energy, industrial, and medical industry. So they do high temperature alloys, nickel, copper, soft magnetic, stainless steel, titanium. Steel stocks have been doing really well, like a Steel Dynamics. So anyway, this is like a precious metal commodity company where if you look at a lot of precious metals like copper, silver, gold, on the 1 year chart, they're up like crazy. So this probably just benefits from all the worldwide supply chain logistics, and they benefit from inflation and the Strait of Hormuz being closed. That being said, though, would I buy this one at an all-time high? No, they're at a 50 forward PE. But also, I definitely would not fully sell out of that company. I'd maybe trim a little bit, but I would not fully sell out of that one. I got to see MBLY. What is MBLY? That's Mobile Eye Global. Huh, dang, they're at a basically all-time low right now, so I feel bad if you own this one. Dang, but even at this all-time low level, they're worth still $7 billion. Morningstar says they're undervalued. However, the lack of profitability and highly uncertainty regarding a potential value trap warrants significant investor caution. Do they actually cover this one? No, they don't really like give any thoughts. I don't know what Mobileye does. Maybe we can find out. So the revenue is kind of the same that it was in 2023. So that might be why the stock has been flat or downtrending, because it can't escape this market cap level. Why would they get a higher valuation when the revenue is lower than what it was? So, and the net income looks choppy. It says they lost $3 billion this quarter. It was a one-time adjustment, but even excluding that, they're still losing like close to $100 million of net income every single quarter. They still have a good a balance sheet. That's good news. But so 1.13 billion of cash. So like 20% of the market cap is their cash on hand. They have no debt. They also just did an acquisition, and I'm glad I just scrolled down to the shareholders here. Did y'all know this? Because I didn't. Freaking Intel owns 77% of the company. So it's kind of in Intel's hands. Intel can, maybe they'll fully buy out the company. So Intel, this might have been a spinoff from Intel. Oh, I just noticed they're actually headquartered in Jerusalem, or in Israel, Jerusalem. So Israel stocks are more risky than US headquartered stocks. So anyway, that one you might want to be careful with. But it was cool to see Intel own that one. We have a fundamental disagreement on how we see it now. I have to look at adjusted with Armina's purchase. Yo, I just don't know. You should do like a 2 or 3 year out forward PE, because I think you're saying that the acquisitions that ServiceNow just did is making their EPS look artificially low. Even if that's the case, I don't see them making in GAAP net income $1 a quarter for the next 4 quarters in a row. Like, that is historic. Like, just for the rest of the time to do on this metric $1 a quarter. But it is, I don't know. I just like to use the stock-based comp most strictest metric there, because if you go to that same website, actually it's not just a ServiceNow issue. If you go to UiPath, that website says UiPath trades at like 9 times net income. That is definitely not true. I wish it was true as a UiPath shareholder, but UiPath trades at a 28 forward PE, or 28 times next year's net income. And there's no weird acquisition to like make the things look different. So actually, if you want to research that more, my music, go check that website out with other software stocks as well, like UiPath. But yeah, I like this discussion though. NVIDIA versus Intel, which would you go for? Definitely NVIDIA. Definitely NVIDIA over Intel. Plus, if you buy NVIDIA, you get exposure to Intel. If you didn't know, NVIDIA bought Intel at $22 a share. They're up over 10x. Oh, no. They're up over 5x on their Intel investment. It's actually their largest holding. So to kind of please, basically the US government has a 10% stake in Intel. The reason is because we have a very valuable technology of chips. All of these chips are being manufactured by Taiwan Semiconductor in Taiwan. And that's not good. That's 10 feet away from China. We need to be more manufacturing independent for these, rare items and this technology that could, help our enemies. So we're trying to be more manufacturing independent. Thinkorswim is a Schwab trading tool. Oh, really? I've not heard of that before. So that was the stream, guys. I hope you have, I guess someone said ServiceNow. Yeah, we were just looking at ServiceNow. Basically, the thing is, ServiceNow is super impressive. Like, valuation aside, this is super impressive. Like, literally by the quarter, ServiceNow just hits like a record revenue every single quarter. Like, not even like by the year, but by the quarter they hit a new record revenue, and they're still making a couple $100 million net income a quarter. Back here it was a really tough buy when they were losing money every quarter. Well, now they're very consistently making very nice net income. Here's the net income projections. They're supposed to make $330 million next quarter, $580 million the quarter after. So US is 60% of the revenue. Morningstar says they're undervalued. Rapid AI monetization, continuous product expansion beyond core IT functions, and strong margin expansion potential will drive long-term value growth. Pretty cool. I wonder if there's, so here's what the bulls are saying. ServiceNow has organically expanded beyond ITSM into other areas, including customer service and HR service delivery, enabling more durable growth. But here's the bears. As ServiceNow expands deeper into areas outside of core IT, it has encountered an expanding set of competitors. Some of these peers are well equipped for battle. ServiceNow has more recently turned to acquisitions, including larger deals, to expand its reach. Increased acquisition activity raises integration risk and muddies the firm's organic growth narrative. There is fear that AI models can replace applications like ServiceNow's or pressure the seat licensing model. So that's kind of the two things that are balancing out ServiceNow right now. So I hope you have a great rest of your Saturday. Feel free to tune into tomorrow's stream. We're going to be streaming tomorrow. I'm in Eastern time. It's 10:30 p.m. for me. I'll be streaming at 12:30 p.m. tomorrow, or no, at 12 p.m. tomorrow Eastern time, New York time, main stock market time, New York time. So anyway, have a great rest of your Saturday. If you want to help me out and you haven't already, please leave a like. It does help me out if you leave a like before you go. And see you, man. Enjoy the weekend too. See you, my music. Yeah, that was a fun discussion. Hey, and it's definitely a good question you bring up to see what are the right, stock-based comp or metrics to use and stuff. So see, or actually I'll end with the portfolio update. Here's my Moomoo portfolio. This is called my buy and never sell account. I go to a bunch of other live streams. No one shares their exact purchases, their lifetime performance on every stock, their lifetime stock portfolio performance. Like this account right here, this is my best performing portfolio, so I really don't have anything to hide, but I put 18 grand and that 18 grand has grown $35,000. And so this whole account's worth 52K. Most of those gains have came from Comfort Systems and Powell Industries, where this whole thesis is once I buy a stock in here, I literally am never allowed to sell it. It's been tempting for real. Like Powell Industries, I'm up 1,000%. I've never trimmed one share ever. So it's a total experiment. So feel free to subscribe. If you come back in a year, we'll own all the exact same stocks. Next up is my Webull portfolio. This one I have no rules. I can buy and sell whatever I want, but mainly I just buy and hold the same companies. But I do have some extra cash on hand. We saw how volatile the market is right now. Now's the time to, have a little bit of extra dry powder than normal. Because some evaluations are looking a little stretched. But yeah, I got $900 of cash. I'll let you know what I buy next week. I'll potentially buy something next week. So yeah, we're up 29% all time in here, or $4,200 open profit and loss. And here are my biggest losers in here. Yeah, speaking of UiPath, yeah, we're down bad on UiPath. We're down on Futu, Sprouts Farmers, Progressive, and Netflix, which is our most recent purchase. But here is our best performers. We do have some popular names in here like AMD, Robinhood stock, Clear Secures, that airport company, Reddit, very cool AI software data licensing new revenue stream. We got SoFi. I actually just bought another share of SoFi at $15.65. AppLovin, Microsoft, Uber. So that's that portfolio. Then finally, we have a Robinhood account. This in the top left is called my dividend only portfolio because I love dividend stocks. And I eventually, in 10 years from now, I want to live off my dividends. Now is not the time for me to go in on dividend stocks yet with the high yield, because I want companies that are mainly going to grow a bunch in stock price. And historically, companies that have like really high dividend yields, like 5% plus dividend yields, they don't grow much in stock price appreciation. And there's like a metric. If a company has over a 5% dividend yield, it almost certainly will never outperform the S&P 500. Or even the higher the yield, the almost more certain you can be on a total return basis, it's going to underperform the market. But that being said, that means the current dividend yield, not yield on cost. So the thesis is like Warren Buffett, he bought Coca-Cola like 50 years ago at and let's say at the time it had like a 1% dividend yield. Now he gets like 50% of his original investment back just in a dividend every year from his dividend yield on cost. So the thesis is in 10 years from now, McDonald's or Google or Meta will have 10x their dividends. So where, yeah, today I'm buying the stock where it only has a 0.5% dividend yield, but in 10 years from now, maybe it'll be a 5% dividend because they've 10x the dividend because their payout ratios are so little. Anyway, here's the total percent chance on every stock in here. Google has been our best performer. McDonald's is the only stock we're down on. United Rentals is benefiting from AI data center construction. We have Carlisle Roofing, CEG, the nuclear company that owns the most nuclear plants out of any company in the whole US, purest nuclear energy play. And we got Meta. Meta's been struggling. And then we have a Roth IRA. Roth IRA is just a tax-free retirement account. We started this one exactly or just over a year ago, and we haven't done too well. We're down 1.7% all time, and that's mainly because of our HCA Healthcare investment. This is down $500 or a 15% loss. Oh, we got a little dividend coming in from HCA, not too shabby. But yeah, Innodata, that's that incredible software company that 5 of the Magnificent 7 are customers of. We're up 181% all time. Too bad I only bought 10 shares. Hey, what's up, Edward? Anyway, that was the stream. Please leave a like before you go. Feel free to show up to tomorrow's stream. Hit the notification bell to stay notified. But yeah, tomorrow at 12 p.m. Eastern and 8 p.m. Eastern. See you, Steven, Haru, Edward, Michael, Circle, Brian, and everyone else.